Right, good morning, everybody. I actually remembered to start YouTube today, so we should have a video of this one. You guys try to say something smart for me. Good morning, everybody. Andy, Ron, Cav, Miss Cindy, nice to see you guys. Hope everyone's doing well today. Um, Good morning, Erla. Hope everybody's motivated. Hope everybody is excited. Good morning, Miss Debbie. Cav, it's hump day. Andy Man changed his name. I like it. He used to be Andy Boy, and then he grew up. To every season, change. Guys, welcome to the education room. It's nice to have you guys in here. I know I'm a couple minutes early, so I'm just going to ramble a little bit. We'll check news. Um, Good morning, user. As you guys know, I like to try and simplify everything. One of the things that I did this morning, since class isn't official yet, I'll show you guys what I'm working on. We're calling this one the So What document. So guys, tell me if there's anything that you want to add to this one. This one's going to be a growing kind of thing. So what, right? Chart reading is what we do, guys. That's the most important thing that we can do. Our chart reading lets us know what's going on. It lets us know if there's advantages. It lets us know if there's disadvantages. Chart reading lets you know if your rules are met. So what do you do with your chart reads? And this was inspired by a picture dropped in the room of what we consider to be a weak bottom, not a strong bottom. And I'm like, okay, you've identified the weak bottom, but so what? What does that mean to you? Right? And if you're not sure, then we can begin to create expectations. So whether it's a strong top or bottom, whether it's weak triggers, whether it's split triggers, guys, I'm starting this document called the So What document. So maybe you have a thing, right? Maybe you see something over and over. Mark, I keep seeing these pivot stop outs at fibs. What does that mean? Like, what does that mean to me? Bring it up in the room, talk about it, and let's fill out and grow that sheet together. And then I think I may have even posted this one in the room. I'm not sure. But what's your read, right? What's your chart read? Does it give you the rules met? Does it give you enough positives to outweigh the negatives? Does it create expectations? And all of this is chart reading, guys. This is what we're going to talk about today. And every time I look at a chart, this is me making this personal, guys. Good morning. You don't have the screen. If it's just spinning dots, Gary, it may be on your end. Um, Andy can't hear. You guys can hear me. Give me a Y if you can hear me. Guys, I'm going to tell you right now, Discord has been a pain in the ass lately. So let me do this. If you're having challenges, Control, Alt, Delete, and kill Discord from the task manager. Reopen. There we go. Guys, if you have Discord issues, that's the best way. I've had to do this twice today. Sometimes you guys copy and paste your pictures in and it won't let me open the links, and I have to do that to be able to open the links. So if that's going on, do that. While we're doing it, guys, I'm leading with this chart read thing because this is what we're doing every day in this classroom is we're talking about chart reads. And every time I look at a chart, I think about it in terms of momentum, a clear path, and entry. Three very simple concepts that we're going to talk about for the first hour. And momentum and a clear path, guys, the rules for that's never going to change. You're either going to have it or you won't. It always is or is not. It's very Yoda. But entries are abundant. Entries based on advantages, guys, there are a million entries to be taken once you learn how to read the software. And you'll see it throughout the day. You'll see a lot of different entries that have enough advantages for that user to justify. You just have to find yours. So finding your entry is going to be the goal today. Finding your entry is going to be the goal. But before we do anything, we're going to check news. It's 9 o'clock, right? Okay, we're 9. Every day I come to forexfactory.com /calendar and I look for news. I look to see if there's anything going on. Today is Wednesday, May 8th. Cindy had a 48-hour head start on this one. Guys, at 10:30, there is crude oil inventories, which means that all the people that trade crude oil are waiting for this announcement about whether or not there's enough barrels in reserve or what the number is. And then there's going to be a lot of people with very deep pockets reacting to it, some of them favorably, some of them not so favorably, which means that when a news release comes out, it has the potential to spike the market, to make it jump, bump, go a little crazy. So every morning I'm checking news, and this is really one of the first advantages that I give myself is knowing when these releases are. Typically, I look for high impact and I look for medium impact. But if there's none going on, I still look to see if there's anything pertinent to me. I'm looking, and today it's crude oil. Crude oil is something that can affect the crude oil traders. Good morning, Jonathan Chris. Nice to have you in the room. Welcome to the Nexgen Education Room. So guys, I do this every day. I check news every day. I pour a cup of coffee, I load my charts, I check news. I look at what I did yesterday, I check news, I make sure that I don't trade in front of it. And then everything that I talk about every day can be found on the education page, guys. Everything that I talk about comes from the education page. The education page is your Ninja Trader how-to. The education page is all of the rules that I talk about, and even a glossary of common terms for you newer users. Um, I want to go to the glossary of common terms, and just like I do every day, I want to highlight. For those of you that are brand new with me, the way this classroom runs is I spend 1 hour talking about a high probability trend trade. I spend 1 hour focusing on a trade that typically wins 70 to 80% of the time. I spend pretty much a full hour talking about a trade that is designed to create confidence through the success that it brings. High probability trades are defined when each indicator on every chart agrees for the rule for the trade, guys. Strongest triggers, nothing in the way, nothing between you and your targets. This is the absolute best of the best, guys. This is the confidence builder. This is the trade, though, that teaches you to read your indicators. You have the greatest software in the world. Now you have to learn how to use it. And learning how to use it involves learning how to read it. And high probability trend trade is the easiest way to do that because you're going to focus on three very key concepts, three very simple advantages, and you're just going to put yourself in a position where you can speak to yourself in regards to those advantages every time you look at the chart. Your high probability trend trade will take you to a medium probability trade. Your ability to read charts will take you to that next level. And a medium probability trade, where I'm going to give you a plan for one of these as well, is defined as when most of the indicators line up for a trade. However, small issue exists. Your ability to read your charts is going to identify the small issue, and you're going to determine whether or not it's enough of an issue to keep you out of the trade. This will be the vast majority of your trades, and you'll see that more and more as you spend time in this classroom, that while the high probability trend trade teaches you to read your charts, while it gets you focused on recognizing advantages, very rarely are you going to find yourself in trades that are 100% perfect. And you'll rely on your chart reading to allow you to manage those assertively, to recognize trouble in your way, to get to a zero loss level. And your ability to read charts will dictate how you manage these trades. So we're going to focus on the high probability. We're going to give it an hour. When we're done with that, I'm going to hand you a rock solid plan to trade the high probability trend trade as well as one medium probability trade. I'm going to give you a rock solid plan to turn you into a chart reader, to be able to recognize all the advantages faster than if you were doing it on your own. I'm going to give you everything that I own in my arsenal to help you get exactly where you want to be. The only thing that I can't provide you guys is repetition. The only thing that I can't do is force you to participate. So that'll be on you. I'm not going to beg. But your step-by-step path to becoming a confident trader, ASAFP, guys, post in the room. The people that post the most get to where they want to be the fastest. The people that ask the most questions get to where they want to be the fastest. The people that annotate their charts, that take the time to tell me everything that they see, why they did it, these are the people that get to where they want to be the fastest. How do I know this is true? Because I've been working with you guys for 3.5 years. And it's never changed. You guys that hide things, make the same mistakes over and over. You guys that don't share losers tend to repeat your losers. If you've been in my class and you're not where you want to be, but you're not posting in the room, that's on you. But you will get out of this room exactly what you put into it. So drop a little effort in there, guys. And then the next thing is use the spreadsheet that Nexgen provides you. The spreadsheet has 4 tabs. This is in your Nexgen Study Picks folder. It comes standard with every software download. I'm going to give you mine in the room. You can download it straight from the room, and you have the most current, updated, filled out by Mark copy of the spreadsheet. The first tab is your trade journal. Every time you take a trade, especially when you're learning on simulator, win, lose, or draw, guys, take the trade, annotate the chart, put it in your spreadsheet. Talk about how you felt, what you saw. And then when you post it in the room, I'm going to give you feedback. I'm going to go back to speaking about advantages. I'm going to look at entries. I'm going to look at exits. And guys, every time you post in the room, it's a private session with me. It's you and I hanging out with a couple people watching. But I'm going to give you feedback. There's a whole section for you to take that feedback, to put it in there, and then come back and study it the next day. As you learn the high probability trend trade, there is a tab with each of the rules in green being met, each of the rules not being met. Your job is going to be to take pictures of what it means to have your rules met, to put them into the spreadsheet, and to commit them to memory so that it's easy to recognize. As you learn the high probability trend trade, as you see medium probability trades with a lot of rules, a lot of advantages met, you can begin to put them into the third tab. And this is where you guys are going to start building your trading plan. Initially, your trading plan is going to revolve around entries, taking the right entries, getting into the market where the market is most likely to continue. From your great entries, you're going to have to learn to manage them. You're going to have to do something with those great entries. You're going to begin to see patterns that repeat themselves. You're going to recognize areas that may stop the market. Fill out your spreadsheet. 15 pictures every day should be the goal for everybody. And then the goal is to make it look like mine. This is the one where I take stuff from you guys in class. There are entries for the high probability trend trades, both long and short. There's a little over 300 pictures of you guys taking high probability and medium probability trades. These are client trades, guys. These are trades of people using the software, people that learn to read their indicators. And some of them maybe don't follow the rules 100%, but that's okay because we're creating individual plans. There's a section dedicated to the NASDAQ for you adrenaline junkies that feel like you really need to be a NASDAQ trader. I'm going to warn you right now, caution you, that if you are not comfortable with your chart reading, if you can't make decisions almost instantly, the NASDAQ will more than likely chew you up and spit you out. That seems to be the norm. So most of you should be focusing on crude oil and the S&P, those very mellow moving markets initially. Learn your reads, and you can work your way into the NASDAQ. I'll help you when it's time. There's a whole section dedicated to management. I've begun filling out the patterns that repeat themselves because that's all the market is, guys, is it's just patterns. It's the same darn thing over and over and over. And when we see something enough that we can test it, that we can make sure that it's repeatable, and then most importantly, we can make sure that it wins more than it loses, that's how these patterns become rules. And then a whole section on termination conditions. So get in the habit of filling out your spreadsheet every day. And more importantly, get in the habit of going back and reviewing what you did yesterday. Ask yourself what worked, what didn't work, what made you feel relaxed and comfortable, and what didn't. And Cindy says, hey, Mark, check it out. I'm working on mine. I love it. And what do you think, Cindy? And I'm asking, and I know that I've already asked this, but I want to do it again. When you go back and you take these pictures and you annotate these pictures and you talk about what you see and what it means to you, is it making it easier to see it? Does it feel like it's slowing down the market a little bit? Absolutely it does, guys. There is very much a method to my madness. And for those of you that don't know, there's nothing that you will ever make a mistake on that I haven't already made the mistake on. There is no termination condition that you can trade into. There's no early entry, late exit. I've done it. I've done it all. So my goal is to help you avoid some of these pitfalls. We're going to take an hour. We're going to learn the Fibonacci rules, the trigger line rules for when it's okay to trade. We're going to talk about advantages. Advantages is going to be man, that's all we're going to talk about. Advantages, advantages, advantages. You guys simulate, practice, break some eggs, make an omelet. You can't get great at this by just watching videos, guys. Nobody's going to watch Tiger Woods go play in the Masters and shoot a 65, right? Nobody's going to watch Scotty Scheffler putt and become a great putter. You've got to get out there and get some reps. You got to go to the batting cages. You got to go to the driving range. You got to practice it, but practice it correctly, right? You're not going to swing out of your shoes every time you have a driver because you're never going to hit it straight. But if you do it right, you create that muscle memory and you can do the same thing every day. We're going to simplify. We're going to simplify one high probability trend trade. But yeah, Gino, the statistics would suggest otherwise. He's not the best putter, but he can't be a terrible putter because he's hitting an awful lot of birdies and an awful lot of eagles. He's gotten better. He's gotten better. I'm a great putter, but I suck at everything else, so my score reflects that. Guys, we're going to simplify. I'm going to give you a recipe for a high probability trend trade, a trade that typically wins 70 to 80% of the time when you follow the rules. They still haven't said who's playing. Pro-Ams are cool. I like the Pro-Ams. I like the celebrity Pro-Ams. Those are fun to watch. And I'm going to give you a plan for a medium probability trade, guys. We're going to take one of the best and one of the not quite the best. So I'm going to give you the best way to take both of them. But you've got to learn the looks so they become easy. You've got to take pictures. You've got to commit them to memories. Really, you've got to break it down into pieces so that you can create the whole. So this is going to be our plan today. We're going to talk about a trade that only takes 2 charts to recognize. And on the most current bar of your largest chart, guys, your large chart is a slow moving chart. Your large chart is it's a freight train. It's rolling down the track. And you're going to use the most current bar. The most current bar is going to define the direction, the momentum, and the areas. If the background on your large chart is green, the market's going up. It's easier to go up with it. If the background is red, it's going down. It's easier to go down with it. Your large chart will let you know if you have the advantage of momentum through rule number 1 for that high probability trend trade. Your large chart will also let you know if there's nothing in your way. If you have a clear path, that's going to be rule number 2. 2 out of 3 of the high probability trend trade rules are met on the large chart, and you should never even look at a smaller, faster chart until the large chart says, hey, Cisco, it's time to take an entry. You know, hey, Jonathan, here's a couple advantages. Let's go find a way to capitalize. Guys, that's when we turn our attention to the small chart. Large chart leads the way. Small chart is it's a refinement chart. What happens inside of this one bar, we create an X-ray. We look at about 20 to 30 bars worth of movement inside of this one bar. This is where we're going to refine that broad stroke of a brush. We're going to be able to pinpoint where the market is most likely to continue. And guys, this becomes your entry through rule number 3. This is where you're going to reduce your risk, where you're going to maximize your profit potential. And guys, if you ever start typing in the room and then change your mind, maybe that's not a good question, get back to typing. Finish it out, hit enter, and let it fly. I see a lot of people in the room start to type. It shows me when you're typing, and then it just disappears. So guys, finish your thoughts. If it was important enough for you to begin to type out the message, finish that message and drop it in the room. It's important to me. So these 2 charts, guys, we use them because it's really just kind of a reflection of who's in control. Your large chart is this giant crowd of people, right? This is 50,000 people at a Beatles concert. The big chart is going to define what the large crowd wants to have happen. It's going to define the direction. It'll define the areas. It'll define the momentum. And really, this is just what the large crowd wants. The small crowd fights the large crowd. It creates this little pushback that we can take advantage of. But ask yourself, who do you want to trade with? Do you want to trade with everybody that's in charge, the people that move it, or do you want to try and be a fighter? Fighters lose a lot, but we like the fighters because you'll see when we go after our entries, the fighters get you guys trading with the flow to the best of the best entry where the market is most likely to continue. So we're going to focus on 3 rules. This is your high probability trend trade rules, guys. The high probability trend trade is a trade that typically wins 70 to 80% of the time. The high probability trend trade is the trade that creates an awful lot of confidence through the memory of success. The high probability trend trade is a trade that is revolving around advantages. Each rule creates an advantage. Your first rule says that your large chart, right, the one that leads the way, must have strong trigger lines. And if it does, down here in yellow, it lets you know that that is going to provide you the advantage of momentum. Your large chart must also have no termination conditions, which means that you haven't reached a line that could stop the market, someplace that could end the trend, something that could create an untradeable bounce. And when the termination conditions are false, you're going to have room to your targets. And when you have room to your targets, we're going to call that the advantage of a clear path. And then finally, once I have momentum and once I have a clear path, I'm going to find an entry area. For the high probability trend trade, it's going to be using areas on a smaller, faster chart, a refinement chart, to get you in with crazy precision. But a trade is nothing more for the brand new user. The accumulation of momentum, a clear path, and an entry area. Like that's your little algorithm to get you where you want to be. Once you grow with the software, once you're good at reading charts, once you can speak to yourself in terms of advantages every time, really just momentum and a clear path, you're going to begin to find the entry that works best for you. But until you can do that, I'm going to strongly urge you, I won't tell you what to do because I don't give trading advice. I refuse to give trading advice. But what I will do is I'll say that this is the easiest way to get to where you want to be. This is the fastest way to becoming a chart reader. This is the 100% expedited path to making you comfortable with your software and putting you in a position where you can take advantage of the patterns that repeat themselves every day. So everything begins with strong triggers on a large chart. The only way that I can have strong triggers on a large chart, guys, is if the trigger lines match the background color. Let's keep it simple and focused. If my background is green, the market's going up. I'm only looking for rules to be met for high probability trend trades long. In order to have strong triggers, my small triggers, which are these solid lines, and my large triggers, which are these dashed lines, triggers are nothing more than moving averages, guys. And I'm going to tell you right now, you do not have to know how to build a watch in order to tell time. All you have to know is that when the smalls break above the large, when space is created, this is a strong trigger look. And a strong trigger look means that the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum, guys. You're going to hear that in the room all day long. Odds favorable momentum pushes a market. Odds favorable momentum can break key areas, and odds favorable momentum can even cover mistakes that we all make as new users. And when I have odds favorable momentum to the upside, I'm going to use a smaller, faster chart to buy Fibonacci support. It looks like a tail or a wick on this large chart. You're going to use that refinement process to pinpoint exactly where this tail is most likely to form. When the background is red, when the market's going down, my small triggers must be red, my large triggers must be red. There must be space between the two, and that gap lets me know that the odds are favorable for the market to continue down. When I have strong triggers down, it is the best of the best time to use that refinement chart to sell Fibonacci resistance, to enter the market. You guys will be able to pinpoint where this tail is most likely to form on a slow moving chart. So rule number 1 is momentum, guys. Rule number 1 is the advantage of a market that's likely to continue in the direction of the trend. Smalls above the larger wide. There's one of those tails, guys. I want you to start getting in the habit. Circle a tail when you see it. Let's go see if that was an entry. Maybe it was, maybe it wasn't. But is everybody good? This is odds favorable momentum. And if I just expand this a little bit, this is odds favorable momentum. There's a tail. There's a strong grinding market down, but it began with odds favorable momentum. Guys, this is the first. This is the best. This is the one that pushes the market. This is the one that will break areas. This is the one that covers mistakes. And odds favorable momentum is not a forever endeavor. It's fun to say, right? Odds favorable momentum is the best of the best for short trades. So as a brand new user, it just makes sense. Focus on the best of the best. You're going to be able to pinpoint where that tail is most likely to form. The advantages are going to be in place, and you're going to find yourself with a higher win rate, making you feel great and comfortable and confident with what you're doing. As the small triggers come back and one of the lines gets inside of the large triggers, this is the first sign that momentum is slowing. So short trades can still be taken, but the other charts have to agree. You've got to rely on your chart reading to make sure that everything lines up and is good. And then when both triggers are down, once both of the small triggers are inside of the large triggers, this is a weakening or a slowing of the trend, guys, and anything can happen up or down. You're going to hear anything can happen triggers in the classroom a lot. Anything can happen triggers can create deeper retracements. Anything can happen triggers can reverse from the middle of nowhere. Anything can happen triggers are more likely to let us know that key areas are going to hold. So as a brand new user, you're focused on the best of the best. With some reps under your belt, you start getting a little loose with it, right? I can recognize advantages. I'm feeling good. I know when my charts agree. And then down here, it becomes a crapshoot, guys. And what it's going to do for you is these weak triggers maybe won't be the entry, but they'll let you know that it's time to take profits at key areas. And that's our segue into rule number 2. Is everybody okay with the idea of odds favorable momentum? It's not difficult to recognize. Odds favorable momentum is nothing more than a separation between the small and the large triggers, guys. I would say 90% of the great trades that I see people take revolve around momentum, and then they find a way to get a little creative with that momentum. Once I have it, once that first advantage is in place, once again on the large chart, I'm going to make sure that termination conditions are false. I'm going to make sure that I'm not trading into an area that's likely to stop the market. These areas on the large chart, guys, they're just lines. And I'm going to tell you right now, and I'm going to say it real loud, I don't rank them. I don't believe that a divergence high line is any more powerful than red Fibonacci resistance. And I don't believe that red Fibonacci resistance is any more powerful than blue Fibonacci support or a divergence low line or yellow 1-to-1s, guys. And we're going to give you the most basic, me and the mouse in my pocket apparently, we're going to give you the most basic way for understanding if these areas are likely to stop the market, if they have the potential to break, and if they have broken. It all revolves around the trigger lines, the same thing that provides you momentum, that lets you know that the market is likely to push. As they begin to weaken, we hit these areas, guys. It's a very easy recipe. Everything begins. I ask myself if my rules are met, Jerry. And I know that that's kind of a weird question. But let's, hold on, and let's back up. And guys, let me Sunday school this for you. My large chart needs strong trigger lines, right, Jerry? So if I have strong trigger lines, then I'm good. My large chart needs no termination conditions. It has nothing to do with color. And I need an area inside of favorable large triggers, area inside of the triggers. Once again, it really doesn't have anything to do with color. The only time I mention color is recognizing which direction the trend is going. So, Jerry, there's about 10 million scenarios where there's the potential for those colors not to match. And we would have to look at every one of them individually and weigh out the advantages. So, will you take a picture and drop it in the room for me? Would you mind doing that for me? Awesome. Thank you for that. Show me those charts and we'll go through it and we'll see what happens. And let me finish the rules, and then what we'll do is we'll go back to the rules and see how it jives. And we'll even talk about what changes the colors on a chart so that we can understand when maybe the advantage is gone. But guys, these areas are where decisions are made by the people in charge. These areas are where the large crowd reacts, whether they're entering, exiting, taking profits, whether they're fighting, it doesn't matter. These lines on the chart are where the people that have more money than you are making decisions. So we're going to go through a very simple process. If price reaches one of these areas, whether it's Fibonacci support, resistance, divergence highs, divergence lows, yellow one-to-ones, if your price bars reach it, if they hit it, guess what? All you have to do is ask yourself, where are my trigger lines? If your trigger lines remain above support, then support is likely to stop the market. It has the potential to reverse it. It has the potential to create an untradeable bounce. Your advantage of a clear path is gone. If price reaches Fibonacci resistance and your trigger lines remain below it, this is an area that may stop the market, that may create an untradeable bounce. It might reverse it completely. So your advantage of a clear path is gone. So if price reaches, triggers remain above. 13.2 defines direction, absolutely. If price retraces to resistance and all the triggers are below, these areas may stop the market. Guys, this is the most simple approach, is just letting the trigger lines lead the way when you reach an area. And then an area is considered broken not by the color of the fib, but rather the location of the triggers. So up here, price reaches support and my small and triggers remained above, small and large. No more short trades, at least in the moment. Let's wait for the reaction. Let's see what happens. When my small triggers and my large triggers get to the other side of the area that was problematic, that area is considered broken, and support will behave as resistance, resistance will behave as support. So what you notice is there's a little pause, and once the small and large get below Fibonacci support, I have odds favorable momentum. My most current bar hasn't reached the next area. I also have a clear path, and this is where you guys are going to pinpoint where the market is most likely to continue. So I'm trying to pull up that crude oil. Jerry, I didn't get a picture from you there. Are you talking about right here, Jerry? Odds favorable momentum. And guys, you can see that there's a clear path, right? Is everybody good with that? This is a large chart. What do we notice, Jerry? Here's a pullback to support inside of triggers. Here's a pullback to support inside of triggers. Here's a pullback. And the synthetics are still up, but you see how things are changing? And then you get that third divergence. So could you take a long trade here? Of course you would. Or could, right? Even though it's red. But, Jerry, do you see how your large triggers are rolling? Do you see how your smalls are getting below the large? And what you're seeing is you're seeing change on the small chart that you can't see on the large chart. You're seeing that in forms of divergences, a loss of momentum. And even though the large chart synthetics are still up, your small chart is completely changing direction on you. So I don't know that I would want to take that long. Does that make sense? And this is going to go back to, and I'm going to take this picture right here, Jerry. This is going to go back to entries when we talk about favorable large triggers. So I'm just going to put that one over here in the cash. But before we do that, guys, let's get back to termination conditions. Price reaches an area. If the triggers remain below resistance, above support, guess what? You have a termination. This is not a broken area. It's not a clear path. If the small and the large break through the area, the path is now clear. This is what we're looking for. We're going with momentum. We're going with the clear path. And guys, there's one of those tails. These are your high probability scenarios, and your absolutely don't do it scenarios as a new user. And this is going to carry you to what we call a 50-50 look. Jerry, do you see how that small chart is dropping like a brick after 3 divergences? We're about to talk about that. Your high probability scenario, your ability to read these indicators is going to bring you to your first medium probability scenario. We call this look a 50-50 look, guys. And a 50-50 look means that your small triggers have smashed through the area. And I want to put that in all caps in the chat box. Smash through the area. 2 to 3 points through the area. When your small triggers absolutely annihilate the area, but your large triggers haven't made it, the area is not broken. But because of the momentum on the chart because of the odds favorable momentum, because the small triggers have gotten so far beyond the area. This is an area with the potential to break. This will be your first medium probability trade that I give you a plan for. So there's three options, guys. Momentum is always momentum, separation between the triggers. A clear path is always a clear path. Small and large above the trouble, haven't reached the next trouble. Is everybody good with that? This is our first little run at it. So when we go through, if I open up a large chart, price just reached support and the triggers remained above. No short trades. Price reached support here, the triggers remained above. Look at the bounce. Price reached yellow one-to-ones. Look at the bounce. Weak triggers don't break support. Guys, this was your bottom. After that giant run down, the market came straight to Fibonacci support and began to reverse. Up at the top, the same thing happened off of resistance. So if you scroll back and you start looking at how many times price bounces off of these key Fibonacci areas, guys, you're going to begin to develop trust. You're going to develop so much trust that when the market reaches yellow one-to-ones and the triggers remain above, you're just going to say to yourself, man, this isn't my trade. I wish it would go down, but it isn't my trade. I want it to go down, but it isn't my trade. I hope it goes down, but it isn't my trade because I don't have a clear path. And guys, this picture is the most important picture for new users because 90% of your day is spent reading indicators. 90% of your day is waiting for advantages. And if price reaches yellow one-to-ones and the triggers remain above, you don't have the advantage of a clear path. And if that area creates a bounce into resistance and the triggers remain below, you still don't have a clear path. And if your colors don't match between your triggers, the smaller up, the larger down, you don't have odds favorable momentum. And guys, for about 45 minutes, you're caught in this just horrible little range that doesn't give you advantages. This is your 90% every day, guys. This is where adherence to the rules keeps you from forming opinions. This is where adherence to the rules keeps you from taking unnecessary losers. If you learn how to exercise your patience bone when your rules aren't met to do absolutely nothing, eventually the smalls get outside of the large. All of your triggers get above resistance. We haven't reached the next area, and you're going to learn how to pinpoint where that tail is most likely to form, guys. And this becomes your entry. This is your 10%. This is your entry for the highest probability trend trade ever. This particular trade was somewhere in the neighborhood of $400 worth of potential. Over here, where the rules weren't met, I could probably find about $1,500 worth of losses, getting stopped out, hoping the market does what I want it to do. And the cool thing is, guys, is that if you never take those no rules met trades, you don't give it up, which means that all of this stays in the account. And that's the goal. The goal is to get paid. The goal is to enter with a statistical advantage. And the quicker you learn these rules, the more adamant you are about not breaking them, the more likely it is that you're going to begin hitting your goals every day. So lines on a large chart let us know where trouble may be. I don't rank them. I don't say that these one-to-ones are more powerful than support or divergence or anything, guys. They're just lines on a chart. They're decision-making points on a chart. Sometimes your large chart can't give you the information fast enough. Sometimes this slow-moving chart will look like it has every rule met. And you're going to go and look for an entry, guys. And this final termination condition is the only one that I recognize and respect on a smaller, faster chart. And I do this because 3 divergences in the same price range may terminate the trend. For those of you that are new and with me, divergence is nothing more than a loss of momentum. Divergence means that when price came down here and went back up, the momentum lagged behind. And if it happens 3 times, you're going to see 3 negative numbers, 3 cyan lines from a low. 3 negative numbers, 3 magenta lines from a high. The negative number is a byproduct of the calculation. It has absolutely nothing to do with anything. It is not relevant in regards to strength. It's just a calculation. But if you see the cyan line, the light blue line print, you know there was a loss of momentum. That's all it was, just a loss of momentum. Doesn't mean that the market is stopping, right? But if three of them print in the same area, well, that may stop the trend. That may reverse the market. That may create an untradeable bounce. And if you see three from a low or three from a high, you have to say to yourself, I no longer have a clear path. I'm not going to take that next entry. You're going to see this look at a low or this look at a high. When you have this look at a low or this look at a high at a on a faster or on a slower moving chart. And I'm going to show you, and Jerry set us up for this lesson real quick. Thank you, Jerry. There is your small chart on crude oil. Live market, guys. Here's your large chart. You had odds favorable momentum. You had a clear path. But you also had three divergences in the same price range. And look what the market did. Look how it pushed down. This is your safeguard to not take that last long, to not hope that a one-to-one inside of green triggers holds the market. So I'm a big fan. And then Jerry, when we talk about entries, when we talk about favorable large triggers, we're gonna expand on your question a little bit. But I want to ask you guys: is everybody cool? Large chart lines determine where trouble is. Large chart lines. Let me know. Your son asked you this question. Is Josh being shy this morning? Didn't want to post it in the room? Man, Josh, I want you to change your avatar to like Powder Puff Girls or kittens or something. Oh, you're working? All right. Man, now I feel bad for picking on you. No, I don't. Don't feel bad. It's fun for me. And you're too far away. Dad started it. But it's a great question. It's an awesome question. So let's talk about entries. And then I do have the video going today, Josh. So if you need to revisit it, we can. But once I have momentum on the large chart, once I have a clear path on the large chart, I'm going to go to a small chart. I'm going to go to a smaller, faster chart, and I'm going to refine that broad stroke of a brush, right? I'm going to take that 1 bar's worth of information, and I'm going to bust it down into 15 to 30 bars. And I'm going to do that so that I can follow rule number 3. And rule number 3 says that I'm going to use a limit order, as this means that you're literally going to wait for the market to come to you. You're going to pick your shot so precisely that you won't chase price, that you won't even wait for anything. You're just going to have an order waiting. You're going to use a limit order at an area. We're going to use fibs, midbands, and yellow one-to-ones. The way areas on a large chart helped us to find trouble, lines on a small chart are going to give us something to bounce off of, something to get in at. And we want those lines to be buried inside of triggers. And ideally for new users, it's what we call favorable large triggers. So Josh, here's kind of the beginning of your answer. When your large triggers, the smoother of the two, and your synthetics, the stepped, are overlapping one on top of the other, same color, wide, angled in the direction of the trend, this is your best of the best. This is the greatest look for finding an entry, because these trigger lines are correction points, is the easiest way to say it, meaning that they're moving averages. And I expect moving averages and price to collide. So these triggers give me a place to put an area, is the best way to think about it. The triggers are like clouds. I don't expect them to stop anything. But if I put an area, fibs, midbands, yellow one-to-ones, right inside of favorable large triggers, it gives the market something to bounce off of. This is how we're going to define our entry, where the market is most likely to continue. When these trigger lines begin to split, it decreases accuracy. Favorable large triggers need to be wide angled in the direction of the trend. When they split, you double the correction point. The accuracy goes away. If they pinch and roll like they did in crude oil, well, then you could never even come close to having favorable large triggers if the two don't line up. And we'll go back and try to find an example where the different color still gives an opportunity. But for 99.9% of your trades, Josh, you want everything lined up beautiful, because what does it mean? If the small triggers are outside of the large, we have momentum. In order for this chart to change color, I want you to see how the small triggers have to get to the wrong side of everything. which means that there's nothing good going on your small chart in a high probability scenario. However, as you grow with the software, there may be opportunities. There may be an opportunity for a short trade from the wrong side of everything, but it'll be dictated by what's going on different charts. So we'll look for examples of both. But we're going to use the two chart process, guys. Everything begins on the large chart. Large triggers say up. Large chart says up. Triggers say momentum. Path is clear. And we talked about understanding how to pinpoint where these tails are most likely to form. Well, we're going to do it by using the smaller, faster chart. And we're going to let you guys remember that small crowd, what it looked like when they fought. Everything says up, clear path, go to the upside, go, go, go. And then these guys come in and fight, create a little pullback. We're going to take advantage of those guys. And we're going to let them push the market right back to areas inside of favorable large triggers. This is rule number 3. And it's not difficult to begin to recognize these entries, but it takes a little bit to trust them, if that makes sense. Because it means that you are literally going to buy the market when it's on its way down on that smaller chart, which means that you have to believe that odds favorable momentum and a clear path is going to increase the odds of the market continuing back up. You're just giving it something to bounce off of. So to find a trade, we're going to go through the process real quick. There is no we, Kenny. There is no we in trading. I think what you meant is, do I pass? And then I have to ask you, are your rules met without an area? So if you don't have, and I'm assuming that you're trading the high probability trend trade, yes? This is your plan? So if your rules say, I have to use a limit order at an area inside of favorable large triggers, but I can't find an area inside of favorable large triggers. It sounds to me as though the rules aren't met, right? So if you're looking for a high probability trend trade, Kenny, and your rules aren't met, you've got two options. You either break your rules or you don't take the trade. Does that make sense? Is that like oversimplifying? If we're talking about the high probability trend trade, either your rules are met or they're not, right? Because this is the only recipe that gives me that 70 to 80% win potential. This is the only recipe that combines 3 advantages to take a trade. Yeah, no, always double check. And then Kenny, here's one of the great things though, and I love this little thing, I made this here, is you don't have an entry area, right? You don't have an area inside of favorable large triggers. Kenny, there's going to be a time where you take that momentum in a clear path and you will fabricate an entry because you're so in tune with the advantages on your charts that you'll say, okay, I don't have an area inside of favorable large triggers. Hold on. And we did this yesterday. I don't have an area inside of favorable large triggers. Let me find Michelle's chart from yesterday because it was such a good example. But I do have everything up in a clear path. Let me line up where that market is most likely to bounce from, right? I'll use my termination condition rules. I'll use a couple other things. And then let me wait for a little confirmation at that area. Does that make sense, Kenny? So this one is a strong trending market to the upside, but without rules met for an entry, Michelle needed to be just a little patient because she knew that she was forfeiting that advantage. Yeah. And you'll see these all the time. I promise you, you will see these all the time. And you'll learn how to take advantage of them. But it begins with going through that very basic process. That very basic process first, learning your rules like a scholar so that you can break them like an artist. Rule number 1 always begins on the large chart, right? I've got to have that best of the best, that odds favorable. Rule number 2, I have to make sure that I don't reach the area. Guys, my large chart says go cat go right now. And it's even coming from a termination condition that reversed the market. We call this a strong bottom if the triggers don't break. This sets you up for the best of the best, guys. So Strong bottom, odds favorable, clear path, and I'm going to look for an entry. Now I can go to my smaller, faster chart, and I have to wait for that small crowd to start fighting, guys. And it begins with a reversal bar. It begins with a reversal bar on the small chart. Your reversal bar isn't the entry for the high probability trend trade. The reversal bar signifies the beginning of a pullback. Once I get the beginning of a pullback, I'm going to identify my trigger lines. This is the first step. I've got to make sure that they're both wide and angled in the direction of the trend. Preferably they're overlapping, favorable. And once I find my triggers, and it takes like a half a second to go, oh, look, top line, bottom line, there's my triggers. Well, I'm going to start looking for areas. I'm going to look for fibs, mid bands, yellow 1-to-1s, but they have to be inside of those triggers for the high probability trend trade. And then once I find them, from the highest point of support, fib, mid-band, yellow, 1-to-1, it doesn't matter, I don't rank them. I need a line inside of triggers to my lowest point of support. In this case, it happens to be yellow 1-to-1s. I'm going to draw a box. And this box represents where the market is most likely to continue. This box is what I'm going to call the window of opportunity. This is where if all of this momentum, if this clear path is going to carry me to the next area, this is the point where the market is most likely to bounce to give me my highest chance of success, guys. Finding this window of opportunity is your first goal as a Nexgen user. This is your first goal as a Nexgen user because it teaches you to recognize advantages, right? It teaches you to say, yes, my market is likely to continue in the direction of the trend. Absolutely, my market has not reached an area that could create a bounce. And for sure, I have something for the market to bounce off of to continue with that large chart. And guys, you're going to have to develop the trust through repetition, through study, through class feedback to activate a limit order. And you will have a limit order activated while that is still just one bar. And you'll have a limit order activated sometimes even when the market is over here because you know where the market is most likely to continue. You understand that this is the area most likely to create a bounce, guys, and that is where your advantage comes from. And we don't trade these tails. We don't wait for the tails. They're all the way up here. Once you can identify that area of support inside of favorable large triggers, guys, you have pinpointed with amazing accuracy where the market is most likely to continue. This is the entry based on these advantages that typically goes to your next key area, guys. This is the one that creates confidence. So you've got to go through it a little bit. The reversal bar begins the pullback. Practice it. Go back, take pictures. Once I get the pullback, once it starts, I'm going to find my triggers. I'm going to draw a red box around my triggers. And then once I have my triggers, I have to find areas within mid bands, fibs, yellow 1-to-1s. And I'm going to draw a second box. And this box represents the point where the market is most likely to continue. Is everybody good with this? Is everybody comfortable? You do have to practice it for it to become second nature. And if you're brand new in this room, guys, this feels like a lot of information coming at you. I totally get that. By day 3, you'll be amazed at how difficult it is not. This is where the market is most likely to continue. And you also have to say to yourself, these triggers are where I expect the market to correct. This is outside of the triggers. This is beyond the correction point, guys. This isn't my entry. My window is inside of favorable large triggers, right at areas, and I'm going to activate a limit order at the top. For a short trade, it's the exact same. Reversal bar starts the process of looking. Identify your triggers, find the lines within, commit to a limit order just below that lowest point of resistance, and wait and see what happens. And about 70 to 80% of the time, if the rules are met on a high probability trend trade, it's just going to go in the direction. It's going to create a winner for you. Life is good, right? But what this methodology does for you, what understanding where the market is most likely to continue does for you, is it helps you manage these trades. It helps you reduce your risk because once you pinpoint where the market is likely to continue, you understand where the market should not go. So you're going to drop your first protective stop 4 or 5 ticks above that point, outside of the window of opportunity. And this is where you have to say to yourself, I might lose, but my stop is beyond the correction point. My stop is beyond the areas inside of the correction point. And if the market exceeds it, well, I've lost my edge. I've lost my statistical advantage. I'm no longer in that best of the best area. And you've got to be willing to take a loss, guys. You've got to be willing to lose, because anything that wins 70 to 80% of the time is obligated to lose 20 to 30% of the time. And it's just a cost of doing business. And you'll get to the point when you see this enough that if your stop gets hit, you're like, whatever, let's wait for the next one. I've got to lose some of these. It's just math. But the cool thing is that if you really are embracing advantages, yeah, Jonathan, Christoph, I know that you are on day one. And it's okay. I think day 1 and 2, you're going to hear the same thing a couple times, and they're going to start to click. And I'm going to give you some stuff to help you study, to go back to look. And trying to learn something new the first day. That's why first day of college, they don't do much in class. They give you a syllabus. They let you know what to expect. They let you know the expectations. And then they give you a day or two to acclimate, and then you really start moving forward. This class is no different. So on day 1, you're just getting comfortable with the idea that there's feedback. You're seeing how things run. But I will work with you every day to make sure that you get to where you want to be, I promise. Drinking from a fire hose. Amen. Guys, with all those advantages, you're more likely to get a reversal bar in the direction of your trend than not. And that's cool, because you're going to reduce your risk a tick or two behind it, below it or above it. And this is how we manage risk as well, guys. By understanding where the market is most likely to continue, we know where it shouldn't go. We also know when it's doing what we expect it to do. So we can reduce risk even further. And this is one of my favorite things, is if you keep your management very simple and you respect these reversal bars, you put yourself in a position to keep your losers considerably lower, and really get the best of the best out of the trade. And when they don't work out, and they won't work out sometimes, you find yourself not giving too terribly much back. Andy, great job getting your goals met today. That's always the goal. So I'm going to ask you guys, is everybody cool? And I want you to see this. This is pretty awesome. Odds favorable, clear path. The circle on the tail lines up with support inside of the trigger. Pretty cool, right? The second little pullback is support, and then those 3 divergences kill it. And it goes right to a termination condition, and that stops the market cold, and now it's headed back up. You can go back on a large chart, and anytime you see the rules met, circle a tail. This is part of the study process, guys. We don't trade the tails. We're going to go back on a smaller, faster chart. Where was that tail? And we're going to say, hey, did we get a pullback to support inside of triggers? And if we did, there may have been an opportunity there. And then you'll go back and you'll continue that process until it begins to become second nature. Here, price reached a divergence high. The triggers didn't break. Guys, this is a termination condition. This is not a clear path anymore. My areas are beyond the triggers. I'm starting to see problems here. My rules aren't met, no matter how much I wish they were. So we're going to start doing a couple of different things here, guys. The first thing I'm going to give you is this right here. So, Jonathan, this is a good one for brand new users. I came up with this about a month ago, and this goes with the spreadsheet. So in order to get to where you want to be, you've just got to recognize some very basic things first, guys. You've got to recognize momentum. You've got to recognize whether the path is clear or not. And you've got to be able to process that pretty quickly. So this is designed to help speed it up, guys. And all it is taking pictures. It is taking pictures of strong triggers. It is taking pictures of clear paths. It is taking pictures of weak triggers, so I know what it looks like when the triggers aren't strong. And if you do 25 of each and take pictures of the entry points, you're just going to fill out the spreadsheet. And I've got it started for you guys. We're like already up over 20 here. Sorry, I had a little bit of a crash. And if you fill this out, 25 pictures of each, it's crazy. how easy it is to recognize strong triggers. Like if I click on this one that says momentum, separation is always momentum, whether it's up or down. And I really start developing this recognition, and I can find it at a moment's notice. And then termination conditions, I think we took this picture yesterday as well, the exact same picture where the recipe is met for termination conditions. And what it does is it commits this look to memory. So, Jonathan, I don't want you to burden yourself with looking for trades yet. What I'd really like to see you do, and I think that this will give you a huge advantage, is focus on the first thing first. Focus on recognizing momentum, that separation between the small and large. And if you just do that, you're going to have this down in a day, probably like 30 minutes. And then you're going to start recognizing the next and recognizing the next, and you're going to piece them all together to create something. And I've created a high probability trend trade checklist that have pictures of what it means to have momentum, so you can use it as a little bit of a cheat sheet, what it looks like to have weak triggers, what it means to reach a termination condition, and what it means to have that termination condition broken, and then defining your entries. So what you can do is you can take that little high probability trend trade checklist with all the pictures and kind of check yourself and make sure that you have that understanding. So both of those just got dropped in the room for you. I'm also going to give you guys the high probability trend trade checklist, which is the same thing but without the pictures. I've never had anybody in the history of this checklist do worse than 70% winners. And I want you guys to let that rattle around your heads for a second. The goal of trading is to win more than you lose. The goal of trading is to preserve equity and risk it when you have advantages. So never, and I'll challenge you guys, I want you to just say to yourself, Novak's full of shit. There's no way this is true. I'm going to go find a market coming from a good top or bottom. I'm going to make sure that I have momentum on both charts and no terminations in that area inside. And I'm going to show him that you can't make money with this recipe. And if you do that, you'll be with me forever, because it means that you're doing the work. It means that you're recognizing the advantages. It means that you're learning how to take the trade the correct way. And when you trade with statistical advantages, guys, it doesn't matter what happens in one trade. It's what happens over 10, 20 trades, right? Are you creating a plan that has been proven to win more than it loses? The high probability trend trade is very much that plan. So I'm going to give you a trading plan. This is the third thing, fourth thing, fifth thing, I don't know. I give you stuff all day long. Guys, this is a plan for new users. The plan is a stepping stone in your journey. And I said it this morning, and I'm going to say it again. Once you can recognize momentum in a clear path, there's 1,000 entries. There's so many opportunities to make money in the market, but the two most important ones to the new users, I believe, are momentum and a clear path. Josh, you're going to find your entry if it's the wrong color, as long as you have momentum and a clear path. You're going to find quick little hits where you can make just a little bit of money if you have a clear path and momentum, guys. And this plan is designed to optimize your chances of success. It's designed to give you the best chance of success with the high probability trend trade and that 50-50, that area with the potential to break trade. It's going to be your simulation, study, class feedback, and continuous practice. You're going to create your own plan. And you're going to see trades that are not high probability trend trades in here. And I'm going to tell you right now, they are all derivative of the study done on the high probability trend trade. Every one of the trades that you see in this room that are outside of high probability trend trades are in some way a byproduct of the knowledge gained from learning the high probability trend trade, guys. So you're going to create your own plan. But the simple plan for consistency, the simple plan to learn to read your charts, the simple plan that has been proven to win more than it loses is the KISS plan. And it starts with don't fight the large chart, guys. Don't fight the large chart. I can't say that enough, because if you can get that from day one, if you can say to yourself on day one, I'm not going to trade against strong triggers. If you can say on day one, I won't trade into termination conditions, you are 70 to 80% better than the average new trader. And this is a little tongue-in-cheek thing put together by my brother, How to Commit Financial Suicide. Trading against the strong triggers, trading in determination conditions. This was put together because those are the two most common problems. You have to define your entry. You have to personalize it. And that's why, Kenny, I said there is no we, right? There's only me. Guys, this is my entry. My entry might look exactly like every other person's entry in here that trades the KISS plan, but this one is mine. This is what it takes to get me in the market. These are the rules that I'm going to hold myself accountable to. And if I break these rules, it's not Nexgen's plan that I broke. It's not anything other. I've not traded my rules. So go through the process of learning to get into the market. Learn how to find the entry for the high probability trend trade. Learn to speak to yourself in terms of advantages and how to pinpoint where the market is most likely to continue. And then you're going to learn how to manage it. That's the second piece of the puzzle. Management really takes an ability to read your indicators. Management is going to be what fights you through sweaty palms and butterflies, right? And you're going to create a different management plan based on your ability to read the indicators. But in the beginning, if you allow management to be just as mechanical as entries, it takes a lot of the pressure off. So your management plan begins with recognizing where the market is most likely to continue. I've got to figure out if there is some way to just have it fit automatically. Don't care about conversations. All right, I don't know how to do that. I'm going to figure it out though. So your entries, sorry, little digression there, saw a squirrel, are going to define the beginning of your management plan, getting in at the area where the market is most likely to continue. This is why I stress that. This is why we spend an hour on it every morning. Your initial stop goes where the market shouldn't. It goes beyond the window of opportunity, 4 to 5 ticks. And if the market goes up and hits it, well, then you're out of the trade. But with all of the advantages in place, more often than not, you're going to get a reversal bar in the direction of the trend. And your new stop is going to be 2 ticks above that reversal bar, or maybe 2 ticks below that reversal bar, if it's a long. And then there's nothing to do. You're either going to get stopped out for a tiny little loss, or your first target gets hit. And for the KISS plan, guys, the first target's only $100 in the distance. And there's a lot of you that are like, oh, I have to make more than $100. Well, no kidding, you have to make more than $100. But is there any reason why you can't make $100 at a time? Back in a different life, I was a personal trainer. And one of the biggest things people did right around February was they would come to me and they'd say, I need to lose 50 pounds. I need to lose 50 pounds. I have to be ready for this cruise in May. I need to lose 50 pounds. And guys, if you say to yourself, I'm going to lose 50 pounds, and then 2 weeks in, you're only down a pound, you feel like a failure, right? If you say, I need to make $1,000 a week, and you don't make it by the second day, you're going to start fabricating. So $100, guys, $100 adds up. And $100 every day of the week is still a $500 week, and that's a $2,000 month, and that's a $24,000 year. That's a pretty good chunk of change for only $100. So don't get turned off by the small numbers. Once you hit that $100, you're going to go break even. You're not going to have any risk on the trade, and you're doing that because this allows you to begin to trust the idea that the large chart said down with nothing in the way. You're learning how to hold on to these moves. You're learning how to embrace the idea that advantages are why you got in and advantages are what you expect to push that market. So you're either going to get stopped out, break even, or it's going to hit that second target, guys. And the second target's only $200 away. And that $200 away means that you've exited the trade, you're not in it any longer, and you're up $300. And if this is the best that you can do every day, whether it's $300 from one trade or 3 $100 trades, guys, that's a $1,500 week, and that's a $6,000 month, and that's a $72,000 year. And that's just going to grow through compounding. So the idea isn't that you need all of the trades. The idea is that you need the best trades, that you need the trades with the highest probability of success, that you need the trades that give you a statistical advantage each and every time you take them. And then from that, you'll grow to that medium probability. You'll take your ability to understand your indicators and you'll go through and you'll be able to capitalize on more and more as you grow with the software. So are there any questions about the high probability trend trade? In the room, I have given you the KISS plan. I have given you a checklist to print out and put on your desktop. I've given you a checklist with all the pictures for your computer. I have given you a spreadsheet, my spreadsheet. I've given you chart reading 101. And now I'm even going to give you the PowerPoint that I use to teach this class each and every morning. So guys, that's the first hour every hour. I know it's overwhelming. It's drinking from a fire hose, but I promise you, do we have momentum on the large chart? What do you guys think? Give me a Y or an N, especially you new users. And let's freeze frame it so that we don't even have to look at ticks. Do I have odds favorable momentum on the large chart? Don't get ahead of yourself. Erla says yes. Jonathan, absolutely. So what does that mean to me? If I have odds favorable momentum, right? This is a drill that you can do right now without having to take a trade. I have strong triggers. What makes them strong triggers? The small are above the large. All triggers are up, and the space lets me know they are strong. What does that mean to me? I have the advantage of momentum. What does that mean to me? That means rule number 1 is met. Do you guys see how I took one look and I associated words with it, right? This look means momentum. This look means rule number 1. This look is smalls above the large. This is strong triggers. I'm going to take this look and I'm going to upload it to my screencast and I'm going to go to my 101 page and I'm going to call this strong triggers. So now I am one more picture closer to being where I want to be. And then I want you to see something. I don't have to be in a trade. Let's take the most current bar. Can we agree that price reached areas and that the triggers didn't break? Gary, you will have one in your Nexgen study picks folder on your computer, or you can have mine right here. I just dropped it below you. If you go to the upper right-hand corner of it, there's a download button, or you can even just click it and pull it over to your desk. So guys, let's go through and let's annotate again. Price reached Fibonacci resistance. My triggers have not gone through. This is a term. No clear path. Rule 2 not met. Does that make sense to everybody? It's the exact same picture, isn't it? And look at that. I could even do that. It's the exact same picture, but now I've defined what a termination condition looks like. I've defined the recipe, what it means to me, and what rule it pertains to. So once again, I'm going to share it, and I'm going to go to my spreadsheet, and I'm going to call this a termination condition. I'm going to drop it in here, and I'm just going to say term. So what I'm doing for you guys that are new is I'm not taking trades. All I'm doing is identifying the parts of a trade so that I can get through. Notice that momentum pushed it through. That's pretty important to recognize. The smalls are through, the large are not. It's not a clear path yet. So everything that I do, guys, every time I look at a market, no matter what market it is, and I'll pull up another one here because I forgot that I crashed this thing. When I draw on charts too much, it crushes its will to live. But what I'm doing is I'm taking the individual pieces, and from those individual pieces, we're going to turn it into a trade. From our chart reads, we're going to decide whether or not rules are met. And this is what the second half of class is going to be, guys, is we're going to start going through and we're just going to look at the pictures that you guys posted. We're going to look at the charts that you posted, the questions that you asked. You're going to get feedback on everything that you posted, and we're going to talk about it. And Paul says, these areas that create a 50-50, are they the native fibs? Are they the synthetic fibs? And then Paul, your short and sweet answer goes back to, and one of the reasons why I said it so much this morning, I don't care. If I reach a line and the triggers don't break, it's a termination. I don't care if it's a 13.2 fib or if it's a 21 fib that's been synthetically put on there or if it's a 5.1 fib. Your recipe for simplicity, the easiest way is to say if I reach an area on a line initially for the brand new user and the triggers don't break it, it's a termination condition. And then what happens is I can also recognize the potential to break, and I can recognize when it's broken. And then as I grow with the software, well, then I can start creating expectations on whether or not this fib is more likely to break than hold. Does that make sense, Paul? I'll start looking at things like how strong my triggers are. I'll start looking at where it's coming from, right? And I'll create expectations based on my chart read. But for termination 101, if I reach a line on my large chart and the triggers don't break it, for the brand new user, it's just a termination condition. And it doesn't matter which line it is. If it's on the list, it makes it. Great question. And then once again, the smalls broke through, so we're not going to call this a strong bottom. When we talk about strong tops and bottoms, we're talking about termination conditions. Thank you for that, John. And John, we love to see a large chart too sometimes. Guys, John Novak wrote the software almost 30 years ago, and he still pops in and offers little helpful things. So guys, when I talk about a strong top or a bottom, I want you to see the difference between the two. When I have a no triggers through termination condition that reverses the market, this is what we call a strong top. And a strong top means that these areas are more likely to break, but not guaranteed. Paul, a strong top means that your short trade into Fibonacci support has a better chance of winning with the momentum and everything than it does if it doesn't. And then when a trigger gets through, we can't call it a strong bottom. We can't call it a strong bottom. It doesn't mean that the market can't reverse and go up forever, but using this very simple recipe for a brand new user keeps you focused on those decisions that are made from key areas, and then it'll give you an expectation. Since this is a weaker bottom, this mid-band, these resistances are more likely to hold. Doesn't mean that they have to hold, but they're more likely to hold. So I can gauge that look and relate it to an advantage, to a disadvantage. I can create an expectation through my chart read. Good stuff, Paul. So, and that's where the so what came from. I have a strong top. So what? So the market's more likely to reverse the other direction. So what? So these fibs are more likely to break with momentum. So what? So maybe I will take a little chance on this short, right? This is a weak bottom. So what? So maybe this fib is less likely to break. It's a weak bottom. So what? So maybe the mid-band is more likely to hold, right? So you're creating expectations. Good stuff, Paul. And then let's look at your next one. Kenny, Paul put this one in there for you, brother. Are you with me? And then Paul, I know you're with me too. Paul says, man, I don't have an area inside of favorable large triggers. But let's talk about all the different reads that are here, guys. Let's go through it, and let's not just think high probability now. Let's think chart read. Guys, this is a strong trending market. This is a market that just keeps down, breaking areas. Absolutely nothing slows it one bit. This is a strong trending market. Get out of my room, John Novak. I'll delete his. So Paul, and then Kenny too. Kenny, this one's for you as well. And everybody, guys, this is a strong trending market. When I get 30 bars with no reversal bar, if I break 3 to 4 Fibonacci areas with no retracement, I'm going to call it a strong market, guys. I'm going to say this is a market that's cranking to the downside. So understanding that, you can see that it's not odds favorable momentum, but it is a clear path. Paul, are you with me on that? It's not odds favorable, but it is a clear path. So let's talk about it, guys. If price reaches Fibonacci resistance and all the triggers are below, can we, by the basic rules of termination conditions, say that this red fib is likely to stop the market? That's just termination conditions 101. Wouldn't you agree, everybody? If price retraces to Fibonacci resistance is likely to stop the market. And this is such a common pattern that there it is right in the user guide, the same picture that I use every morning. So we're creating expectations. I don't have areas inside of favorable large triggers, right? But I do have a strong trending market, and I do have Fibonacci resistance that has the potential to stop it. And that same Fibonacci resistance is the exact same Fibonacci resistance here, Paul. So let's talk bar fight. I have a strong trending market. I have a clear path. I have a fib with the potential to hold. I can line it up with my small chart. So the only thing left to do really is to make the decision. Do I arbitrarily jump in hoping that the fib holds? Or can I use some sort of confirmation, perhaps a reversal bar, to still enter this trade, to say to myself, I'm willing to take this trade with confirmation. I'm willing to take this trade because this says that this fib is more likely to hold to the downside in a strong trending market than this one divergence is likely to push up through the areas. And with a little bit of confirmation, I establish my risk. And I still have room to make money down to the fib. Does that make sense, Paul? It's not a high probability trend trade anymore, but you can start to use the very basic, the foundational approach of momentum, of a clear path, areas likely to hold and break, to determine whether or not you're willing to take a shot at that one. And I can tell you right now, in a strong trending market, I'm willing to take a shot at that one all day long with that clear path. And I'm going to keep taking shots until it fails, because you never know how long a strong trending market is going to trend. Weak bottom, no trigs through, didn't hit support. Triggers are way above support, right? Doesn't matter if the triggers are way above support, Paul. What's the recipe? Price reaches the area, where are my triggers? Right? Price reaches the area, where are my triggers? Price didn't reach the area, so there's just no reason for me to even go through the process of termination conditions. Can you guys give me a Y in the room if everybody's with me on that? If price does not reach the area, it does not set off my recipe for termination conditions. It's just a pivot from the middle of nowhere, Paul. That's all it is. So what's the expectation? Let's go through that. We've got the chart read. The chart read, ladies and gentlemen, is that I have weak triggers turning the market from the middle of nowhere. That's cool. I'm not in charge. What's the expectation? The expectation is that when I reach resistance and all the triggers are down, resistance may hold. It's not guaranteed. I don't know which form of resistance is going to hold. I don't know if it's going to be this fib. I don't know if it's going to be this fib. I don't know if it's going to be the mid band. And especially when my small triggers turn, when my large triggers start to roll, I don't know if it's going to hold at all. So this is one of those times where if I want to go short, I go back to that confirmation thing. And then, Jonathan, I see the question mark on there. The whole recipe for a termination condition is price reaches a fib, where are my triggers, right? Price reaches a fib, where are my triggers? If my small and large get below the area is broken. And you'll see it over and over and over and over. So, Paul, what's the so what? I have a weak bottom. I have a pivot from the middle of nowhere. This is a weak bottom, not at a term. So what? The market may continue down. It may continue up. So my so what becomes, I'm less likely to try anything funny to the upside. That's the easiest way to say it. Because it's not a good bottom, because it's not a termination condition, I'm less likely to try the long. And that's all we're doing today, guys, is we're taking a chart read and then we're creating expectations based on the chart read. Great pictures today, Paul. Thank you for posting those. And then John Novak can wait in line just like everybody else. So Cav this morning said, hey, look at my large chart. I have momentum to the downside. That's like 30 bars to the downside. And Cav knows that his best chance of success, if he were a brand new user, would be nothing but short trades, nothing but going with direction, nothing but going with momentum, right? He's been in my class long enough to know that fighting that is financial suicide if you're not prepared. Well, Cav also knows that when price reaches an area and multiple divergences start printing, that he's probably going to get some sort of retracement, and he takes advantage of it, a la Ron C, right? That's a snake trade. But he also knows that in a strong trending market, that resistance is likely to hold and push it back down. And Cav just literally picks that market apart in between two key concepts. Hey, Travis, welcome to the room. Is it a high probability trend trade? Absolutely not. He's fighting everything for the long. But he's not greedy, and he goes, wait a minute, this chart says down. Let's go back down to the trouble area. Cav, I love it. Like a surgeon, man. Like a surgeon. Is it high probability? Hell no. But is it based off everything that you've been doing for the last year, learning how to read charts? Absolutely. And then Ron says, with a clear path, strong trending market, everything says down. Why not just go ahead and take 6 contracts and go from 93 to 90 and a quarter? And guys, that's about a $700 trade in a matter of seconds in a strong trending market, taking advantage of the clear path. And Cindy says, with odds favorable, momentum, and a clear path, why not take an entry at an area inside of favorable large triggers? And then I'll get out at trouble right there at the divergence high. And Cindy, the only thing that I might say about this trade, and correct me if I'm wrong, that's okay. It's still beautiful. 825, Ron. Good. Cindy, you knew about this divergence high for that long, right? Beautiful target. It also coincided with pink 1-to-1s. How cool would it have been to get in right here and to see an exit right at trouble, rather than giving back $200, $150. And I'm not saying that you have to, and I'm certainly not telling you how to trade, but I'm going to tell you guys right now, one of the wonderful things about what we do is that we understand where the market is likely to go. And I'll tell you, it feels good to get paid. And guys, this market from right here had a big honking bounce right off the termination, and I was out 1 tick above it. And it feels good to get paid at these areas, especially when you know about them, and maybe not leaving so much on the trade into it. That's up to you, though. That's a management thing that you'll have to work through. But you're so good at understanding where the market's likely to continue. You're so good about understanding where the market is likely to go. Why not use that? Why not capitalize on that and really get the most out of your trades? And then Andy says, termination, full reversal, odds favorable, clear path. Did you get scared, Andy, on the entry? He may have left. Notice that one trigger is wonky and the other one is below. These are split triggers, and it goes right to the lower trigger, right where the area happens to be. And he gets out of trouble and gets paid again, and this is beautiful. There's only one area inside the window. Beautiful job, Andy. Great job taking advantage of momentum and a clear path. What more could you ask for? That's the easy stuff, guys. That's the stuff that makes life simple for you. That's the stuff that gives you the highest probability. And then there's the same idea when it starts to no longer be favorable, when it starts to no longer be the best of the best. And then, Jerry, I love that close up there. Nice job. All right, Gary, let's see what you did, my friend. Gary says 50-50 trade fails, right? Has momentum, hits support, small above large. Gary, are you with me in here? And I love it when people ask me, would this be the place to take the trade? Gary, did he leave? Well, hopefully he watches this later. So I'm going to mark up his chart a little bit. Guys, if you ever have to leave early, let me know. I'll look at your charts before you leave, I promise. So smalls are up, larger down, colors don't agree. So let's just go through this and ask ourselves the very basic questions. Do I have momentum, ladies and gentlemen? What do you think? My colors are different. My smalls are below the large. Do I have the momentum that I need to look for a high probability trend trade long? The answer is no, I don't. It's just not the look. And if I go back, I know that this is the look. And then right here, price reached Fibonacci resistance, and all of my triggers are below that area of resistance. Do I have a clear path? What do you guys think? New users, please feel free to play along. This is the stuff that pays dividends. The more time you commit to it, perfect, Koki. No. But I did have an area inside of triggers. Crude oil news, thanks, Jerry. So guys, this is one of those things where you're going to ask me, is this the place to take a trade? Guys, that is absolutely a place to take a trade. It's not the place to take a high probability trade. So I look at it first from a high probability standpoint. And then I look at it again, and I don't have enough information to feel great about it. But that's one of those 50-50 trades that failed. And when it failed, my small triggers absolutely rocketed to the upside, and that's immediate momentum. And price pulled right back to that correction point. And on my small chart with no divergence, it pulls right back to support, right back to the mid-band, right back to my large triggers up. Absolutely, guys. As you grow with the software, you're going to recognize that the immediate momentum here creates opportunity. The easier trade was up here, but this is absolutely an opportunity. But it's an opportunity that you've got to piece together more factors than just the high probability trend trade to be able to catch it confidently or to be able to avoid it when it's not actually met. And then Andy, odds favorable, pulls back to support. Let me figure out where you're at here, 81.45. So one of the things that you're doing is you're showing me this. Bottom edge is not strong. I think it's very strong. It pulled back with every trigger up. You're in a strong trending market. The only thing that I might say, Andy, and I don't know if you're in here, guys, the difference between trading into an area and trading from an area will very often mean the difference between winning and losing. And Andy, divergence from a 1-to-1 is a huge red flag, right? But once you get back above that 1-to-1 and the path is clear, it's easy sailing. It's easy money. And this one worked. But I'm telling you, 1-to-1s with divergence are an outstanding place for a deeper pullback. 1-to-1s with divergence are an incredible opportunity for that market to retrace a little more than it did. So letting it do its thing and heading back in the direction tends to pay dividends when you get a trade that looks like this. Trading from the areas rather than into the areas. But taking the advantage of the strong trend, it paid dividends. John, so many charts. Termination, reversal, termination, weak triggers, pullback. There's that same look, Gary. Man, can't really get on board with this one. And guys, this is one of the things that you're going to see. To John Novak, this trade makes perfect sense, right? We're coming from a termination. My large trigger's above resistance. It's a 50-50. You know, when we go through that very basic, nothing is wide or angled in the direction of the trend. Large triggers are flat. Synthetics are way up here. Divergence from a fib right at a termination condition. Guys, there's a million things wrong with this trade from the brand new user's standpoint. But once you learn how to read your charts, it's not so hard and it makes sense. But I'm telling you guys right now, if you try to do this before you understand some very key concepts, it's going to be problematic. TLC, don't even ask them about the charts. If you're not there yet, it's just going to confuse you. So let's turn his 173 opportunities into 2 charts, guys. This is a termination that created a reversal. This is the strong top. This is the precursor for everything great that happens in the market, it seems. Because of the strong top, do you remember the so whats? So that fib is a lot less problematic because of the strong top. When the large roll, the smaller below it, that is beneficial. When the large trigger rolls, it lets me know that change is happening. When that large trigger lines up with the area, the same area that I expect to stop that market because of everything that just happened, it creates the opportunity for a trade. You'll also notice that the small are well below the large. And guys, this is the NASDAQ. There's a lot of reading that goes into this to create this trade. The brand new user says, I won't trade into here. The experienced user says, hey, everything is changing from a termination condition. I'm going to find an opportunity and I'll manage it aggressively if I need to. Guys, I've been with the software for 3.5 years and I still don't do everything that my brother did because he is just good at what he does. So, Paul, no muser. Let's see what you have. Triggers through the fib. So not a strong top, but gnarly looking. I like usage of the word. Triggers roll, wide odds favorable momentum. Clear path. Enter at the mid band. Inside of favorable large triggers. Muser, can you help me with the entry? Let's go through it. Divergence off the top, right? Odds favorable momentum. Dig it. Do you notice that your large triggers were a full bar away? That's a little bit of a red flag for me. Muser, are you in the room? All right. So I want you guys to see this. This is my first correction point, right? This is my second correction point. So I expect price to come back to the trigger lines. This one does have a line in it. This one doesn't have any lines in it. But the split is there, so the indecision is there. So the possibility to go either way is there. And Muser, I'm not sure if you're listening. When these large triggers are a full bar away, it really kind of takes some of the happy out of it for me. And it's more likely to come up this way. But split triggers once again, right? So even if you said, I'll go from the mid band, but I'm going to wait for some sort of confirmation, you never get it. And then Josh, this might be one of those times where you take a trade where the colors don't match by waiting for that confirmation. Does that make sense, Muser? And man, there's those darn split triggers that we see all the time. Those darn split triggers, creating a huge gap where the market may correct. And this is why every time I talk about favorable large triggers, guys, we're talking about one on top of the other. We're looking for the absolute best of the best. We're trying to give ourselves as a brand new user the highest chance of success. And it comes from that overlapping. And the more that overlapping goes away, the more indecision there is regarding entries. It's a good look, Muser. That huge gap to the large triggers and then the split triggers just creates a couple problems there. And then Paul, guys, here's that same idea. As you begin to lose momentum, but you do have a clear path, Paul, you get in at the bottom of the area. Unfortunately, that mid-band below everything holds. Nice stuff. A little different look. Anything can happen triggers. No areas inside. And you're sitting on your hands. Good stuff. Guys, you're going to learn to take trades outside of the highest probability trend trades once you become a chart reader. Here's my brother reminding me that this is his room. Large chart termination, no momentum, directly into resistance is what the new user says. Let's turn it into two charts again. So let's go through the whole read, because there's more to this than just this look right here, guys. And this is what's important. This is where you've got to be able to come in and go next level. This is where you're going to start to piece everything together. And I love this. I love everything about this. And he's using it as a lesson for Muser. If it's divergence, man, wait for the up bar if it's not perfect. And this is one of those ones where a termination condition takes you directly to a termination condition, right? So once this termination condition holds, there's those super fast small triggers. There's that rolling of the large triggers. There is your large triggers matching up, and then you get a pullback right to the area atom. Guys, this is just like the picture that we saw earlier, but you've got to put a couple different things in place. Do you guys remember when we said strong bottom, so what? It means that this area is less likely to hold against that strong bottom. It means that this trade is more likely to win. And it's just continuation of the trend from a termination that creates a full reversal that's establishing momentum. And even though the entry isn't perfect, waiting for that reversal bar, to say, hey, John, guess what? We know that this isn't the best of the best of the best of the best, but your chart read says, if they start to do what we think they're going to do, let's take advantage of it. And we'll manage out at the first trouble, and then we'll look for the next profit. And guys, I love everything about this trade. This is a trade that will create anxiety and fear in the new user, because there's a lot of chart reading that goes on in the moment to make this happen. And then Muser, he's working for you here today. There's those weak triggers. No areas inside of favorable large triggers. And which one's it going to be, guys? This is the exact same picture that we drew earlier. Which areas is going to hold the market? Hell, I don't know. Let's wait a second. Let's wait and let's give it the best of the best. Let's wait for that confirmation to get the trade going in the direction that we want it to go. And I'm going to tell you right now, guys, John Novak is my coach. He is my mentor. The same way I try to give you guys the exact same. And it's these little lessons here, these little nuances, these little divergence from a one-to-one, sit on your hands, these little things that give you just that little bit of an edge. Guys, they come through your chart reads. These are patterns that you begin to see over and over the more time you spend with the software. So I always go back to the whole idea. Don't worry about what anyone else is doing, but use what they're doing to make your day a little better. Use what they're doing to make your reads a little more accurate. Use what they're doing to make your entries maybe a little more conservative. And what you'll find is that without even realizing it, you're at a completely different spot in your trading based on your ability to read your indicators. And you can't buy experience. You have to experience it and spend most of your time on chart reading, guys. And that's what this classroom does, is this classroom teaches you to read charts. It gives you feedback on all of your reads, and it lets you know what it is that you're looking for. My charts are coming up right now. So guys, as mine come up, I'm going to go take a little break. I haven't taken one yet, and I need to stretch my legs. Sorry, just don't even save that. And it's the same thing that we talk about all the time, guys. You have the world's greatest hammer in your hand. You bought this class so close. The world's greatest hammer in your hands. You've just got to learn how to use it. You have to do it through chart reading. And the one thing that I tell people that I think is probably the most important, and let me see if I can find it, is you have to know these things before you ever sit down, guys. What are your rules for entry? Your rules for entry will change 1,000 times in the next year. And then you have to know how you're going to manage it based on what scenario you're in. Or am I in a high probability trend trade? Am I in a medium probability trend trade? Am I in a momentum trade? Am I in an edge trade? Am I in an HVA trade? Because all of those are going to have a different level of management. So the less you look for in the beginning, the easier your management is as well. What's your daily goal? Be willing to hit it and stop, guys. That's one of the biggest things traders do, is they reach their goal and feel invincible and then give it all back. And the same is true on the stop loss. And if you don't define these very easy things, hey, Ron, have a good one. Enjoy the Pro-Am. I'm going to go play Am at the driving range after class today, so hopefully I can work some stuff out. If you don't have a clear path, if you don't have a clear plan for entry and exit, guys, you're going to let adrenaline, opinions, fear, and greed fuel your moves. And I'm telling you right now, it's not the easiest way to do things. So I'm going to leave you guys with a live market. I'm going to let you do your thing here. I'm going to take 5 minutes. I'm going to stretch my legs. Oh, Koki, have a good one. Thanks for being here. Thank you for posting. Let's see some pictures tomorrow out of you. Let's see some pictures. I want to see what you're doing, what you're seeing, what you're thinking. Man, it's fun. Once you start posting pictures and you realize that I'm pretty warm and fuzzy, you'll post all the pictures. And that's what's going to get you where you want to be. And now that John Novak doesn't have his pro class running, he's going to come in and give you some good stuff too. He's going to come in and give you just these little nuances that he shares with me to help you get the absolute most out of everything you're doing. But I'm going to take 5 minutes. And when I come back, it's going to be 100% on you guys. It's going to be 100% on what you want to talk about. So think about it. Post it in the room. I'll see you in 5. is what happens to 70-year-old arms, period. That is all bruising. All right, guys, let's get into this last hour here. We've gone through all the pictures, right? So let's just do our read right now. This is crude oil. There is what we consider to be a weak top. Why is it a weak top? Because that reversal isn't coming from the fib. It's coming from the middle of nowhere. So what does that mean? If I have a weak top, it means that these areas are more likely to hold. It means that support is more likely to hold, that midband may be a bounce point. And it's kind of exasperated by the idea that my large triggers are a full bar away. Gap theory. Guys, if price accelerates away from those large triggers and hits an area, that area is likely to create a bounce, to go back and close that gap to the triggers, which means that going short into the termination condition is kind of a rough scenario for you. So what would you guys like to talk about? I'm going to put it on you here. I have said everything that I want to say today. I've said everything, all the smart stuff I have. And I've run out of smart stuff, so I need you guys to prompt me a little bit. What's on your mind? What do you want to talk about? What are you working on? That is too broad, TLC. Why don't I go over North America? I don't have the NASDAQ up. So if you want to show me a NASDAQ chart and ask something, that's cool. 34 large, 13 small, Chris L. Gap theory we'll talk about, Josh, and we can go ahead and do that. I'm bringing up another market right now. Cool. So let's go through them in order. So the first thing, TLC. And then, Chris, if you need the workspace for the NASDAQ, go to the resources page and just download it. It'll give you the setup. It'll give you everything that you need there if you download the indicators. And then TLC for the NASDAQ. I'm going to do it in one picture for you. When the rules are met 100% on the large chart, and I can't stress this enough, when the rules are met 100% on the large chart, let me say it one more time. When the rules are met 100% on the large chart, there's two ways to enter on the small chart. The first one is if the small triggers are less than a full bar away when I reach my areas, I'm going to be patient and I'm going to look for an entry on the correct side of the triggers. If my small triggers are a full bar away when I reach the area, I'm going to enter at the area. And go through and study this, and I'm telling you right now, TLC, this little bit of patience will pay huge dividends on the NASDAQ. If the small triggers are less than a full bar away when my area is reached, and let me do it again. Let's find another one. When price is pulling back to my area. I don't know what my bottom means. When price is coming back to my area, when it reaches the area, TLC, when it reaches the area, right there, if the small triggers are below the reversal bar marker, I don't enter. I wait. Because look how they behave as resistance. Remember, and this is for everybody that's trading the NASDAQ, your small chart on the NASDAQ, guys, is a large chart on any other chart. And there is no way on God's green earth you're going against that trigger look on a large chart, right? You're waiting for it to be in your favor. The same is true. So TLC, if you get to your area and those small triggers are less than a full bar away, relax. Wait for the close on the correct side. Get to the right side of momentum. But the flip side is if you get to that area and those small triggers are above the reversal bar marker, if I have time to work my way back to them, then I'll enter at the area. And that is the golden goose for NASDAQ. And if you go through my spreadsheet, TLC, go through that yellow section, and it really outlines those NASDAQ entries. And there's a lot of examples in there. And I think you'll find it helpful. And then if you have any questions about it, take a picture, drop it in the room. Great question. And I know that talk about the NASDAQ is broad, but that's probably the best that I can do for you there. And then Josh, the gap theory. Let me go to my other, whoops. Hold on. That was my untitled workspace. And Josh, here it is right there. Do you remember when I said just a moment ago, when price accelerates away from a large triggers and hits an area, those large triggers are a full bar away, and then TLC, that also happens to be what it should look like for an entry on the NASDAQ. It's likely to close the gap. And that's all it is. And you can use this simple pattern. If price reaches the mid-band or an area, the large triggers are a full bar away, it's likely to close the gap. Don't go short. It's likely to close the gap. Don't go short. That's all the pattern is, Josh. It doesn't say go long. It just says don't go short yet. Give it a second. Let it pan out. Awesome. And guys, there's your termination condition. So let's see, what was the next question? And then Josh, if you need more on the gap theory, if you go to the spreadsheet, once again, guys, I've dropped it in the room about 10 times. There's all sorts of gap theories in there for you. Go look at them. Go back and study them. Go draw circles around them. And then if you have a question about it, let me know. All right, so we got that. We got that. All right, Jerry S., the divergence line affect the 50-50 trade. So let me be clear, Jerry S., on what it is you're asking. Are you asking if I am 50-50 on a divergence line? How does it affect the trade? I just want to make sure that I got it. Let me see if we can find a good, clear example of that. So 13-2 chart, right? Small triggers are through, large triggers are not on the divergence line, just like this, Jerry. Cool. So the way this affects it is the exact same way, 100%, without question, without hesitation, without any need for thought. It affects it the same way that this fib will. It affects it the way this fib will, this fib, this fib. So I'm not using it. I don't weigh them out. I don't give them any special credence. If my trigger lines split an area, it's 50-50, right? Whether that area is a divergence low or Fibonacci support. And because the reason that I do that, Jerry, is because these areas are termination conditions for a reason, right? These areas, the divergence lines, they can stop the market, and just like anything else, they can break. But the divergence line, and we're not seeing a lot of good examples of it, these are areas that can stop a market cold. So if it's a 50-50 on a divergence high or low, Jerry, it's the exact same thing for me. You can pretend it's a fib, right? Like you could take a line and you don't know, because I cover it, whether that is a fib or whether it is a divergence high, but the rules are still 100% the same. It's 50-50. You're welcome. That's a great question. That's an awesome question. All right. Can't drink coffee and do NASDAQ at the same time at the beginning. It will give you anxiety and palpitations. It's true. It's true. So Cisco, the less than a full bar on the NASDAQ, is that what you're curious about? I just want to make sure that I'm answering it correctly. I did answer it? Okay. I'm going to pull up the NASDAQ. We'll go find some real world examples of the NASDAQ. So while that's loading up, let me go to Muser. You said you think you understand what JN said about waiting for an up-down bars confirmation after divergence before entering. You're not picking up the lesson on the second chart posted. Which chart, Muser? Would you mind reposting it for me? Oh, this one. Here we go. Hold on. I got it. You're not picking up the lesson here. So there's your divergence, right? There's your one-to-ones. The divergence says, wait for confirmation. You got that one though, right? Like that part. Let me go to the first chart. So the first chart, JN said, hey, look, divergence, wait for confirmation. You caught that lesson? Feel good about it? I speak very fluent John Novak. This one said, guess what? You got to the mid-band and it didn't give it to you. Wait for confirmation. This one just says that you're still waiting for confirmation. So there is no trade yet. Not jumping in arbitrarily at the mid-band, not jumping in at the triggers. You don't know if it's going to be the fib, if it's going to be the mid-band. So what he was saying here is you're waiting for the next down bar. You're waiting for that confirmation because the large chart says it's probably going down. See how he has a stop right here? This is a stop entry. This is the point where this becomes a down bar. So the only way that he'll get in, is with that down bar. No, Paul, not at all. This is, in my opinion, what gold traders would be doing. Because gold is so prone to overrun. I was looking for one of your charts. If divergence prints on the entry chart, wait. That's it. That's all he's saying. If divergence prints on the entry chart from the high, wait. Get an up bar. That's all he's saying. If it's wide open, Paul, if it's odds favorable, high probability, the entire world is nothing but sunshine and rainbows, best of the best, can't find a damn thing wrong with it, go with the area, right? But if you have a problem, maybe your areas aren't inside of favorable large triggers. Maybe you don't have the best momentum. Maybe divergence printed from one-to-ones. Divergence from one-to-ones, you bet your ass I'm waiting for confirmation. But let me go to Paul and we'll look at one of yours, and I'm not sure if you're sticking around for lessons or not, but where'd it go? I know you posted in here. I thought you did. So on this one, Paul, Weaker triggers, right? It is a clear path. Divergence prints, and none of your areas are inside. None of your areas are inside. How many times have you been run over on this trade? Is it more often? And I'm just asking, you don't have to give me an answer. But this is the look where I don't know if it's going to be this mid-band or if these guys want to push it down to the one-to-ones. I just don't know. So that little bit of confirmation at least lets me know that everything is going in the right direction. And gold overruns so much that I don't disagree with that idea on a gold chart. But again, you got to do what works for you. User, did that clear it up? All good? Cool. And then Kenny. Yeah. I think that it's very useful on areas that have the potential to overrun. It's very useful on markets where there's a little extra giddy up. So for example, the NASDAQ, right? The NASDAQ is a little bit of a psychotic market, and it's not uncommon for it to overrun. So there's a lot of safeguards that you can use to demand that the market goes in the direction. I'm struggling today, guys. I'm going to pull this back up. So pivot that reverses the market. This is a strong top then. All right. So Kenny, let's go through definitions real quick while I black out everything from your view. Oops. Get up here. All right, so we're going to do this. And we will use this as our little study guide. So defining, you know what? Let's not even do that. Let's go to the one that's already written. All right, so this one is called Strong Tops and Bottoms for the New User. Are you in here, Kenny? I'm looking. I don't see him. Hopefully he'll get it. Okay. Okay, cool. Cool. I'm a worrier. It's what I do. So defining strong tops and bottoms for the new user. And I'm going to put this document in here as well. So when you're learning termination conditions, the recipe is, it never changes, right? Price reaches an area, the triggers are above support, below resistance, you have an area likely to stop the market. You're good with that, right, Kenny? Defining a termination conditions? Because termination conditions are where the decisions are being made by the people in charge, and that recipe never changes. If price reaches the area and the triggers remain below, it's always a termination condition. So rule number 2 keeps you out of the long. But when you're looking and you're trying to define a strong top and bottom, the first part is a termination condition. That has to be the first part. Always, always, always. When I'm defining a strong top or bottom, I have to have a termination condition. And can you see on this one, Kenny, we did not have a termination condition, right? We had a market that dropped, but it didn't drop from resistance. It didn't come from the divergence high. It's not from support. It's not from yellow one-to-ones. It's just a reversal, really in the middle of nowhere. We could call that a pivot from space. Does that make sense? Because I think this is the most important part of being able to define strong tops and bottoms, is making sure that you're comfortable with the idea that price must first reach an area. And since price didn't reach an area here, it could never, ever, ever, by the rules of termination conditions, be a termination condition. Just a pivot. So far, so good? I'm going to wait for a reply just to make sure. And that's what I needed to hear. That's exactly what I needed to hear so that I could give you the best lesson. Thank you for that. Divergence is not a termination condition. Son of a gun, man, I'm struggling over here, guys. Divergence is not a termination condition. So what divergence is a loss of momentum. So before we get into strong tops and bottoms, I'm gonna hit it in reverse real quick, and we're gonna go for this one. This is the difference between a pivot and a pivot stop out. And Kenny, what you're doing right now is you're making this the best class ever. So thank you for this. So one of the most misunderstood concepts with termination conditions is when you have a pivot with a loss of momentum compared to a pivot stop out. So for the sake of simplicity, a pivot is any time the market goes up and down, right? That's the first piece. And if there is a loss of momentum at the pivot, you're going to see that divergence line. And you're good at recognizing this, but it's just a loss of momentum. That's it. Don't give it any more value than that, Kenny. It's just a loss of momentum that we see. And now let me show you when they become a termination. When price comes back and retests that divergence high, that's when we go through the recipe for a termination condition. So if price comes back and reaches the area and the triggers remain below, then it becomes a termination condition. So here it's a loss of momentum. Let's use this one. Here it's a loss of momentum. Here it becomes a termination condition. Does that make sense, Kenny? Because price creates this divergence low. It's when price reaches it and the triggers remain above, now it's a termination condition. So the difference between a pivot with a loss of momentum means that price hasn't come back and retested. It becomes a pivot stop out when price reaches it, trades below and back above, or when it trades back above and below. Termination conditions defined. So for this slide, it's only in the second test. So termination conditions defined, Fibonacci-based indicator that may reverse the market based on a comparison of the Fibonacci area versus the T3 trigger strength. So I love that you pulled this up, because let's go through it with your picture too. And let me take a picture of this one. So anytime the market has a divergence low or high, let's go to your picture real quick. Anytime the market has a divergence high or low, what this does is this represents a very specific point in the market where not only could the in control forces, in this case the buyers, not go any further, but you can think of it that the sellers stole their momentum. And you don't see that until about the third bar down, but it creates this pink line. Does that make sense so far? Not only does this line represent where the buyers couldn't go any higher, but you can also see that the momentum was lost as well. So this becomes like a line in the sand. This is the sellers pretty much saying to the buyers, let me tell you a story. If you come back and try to cross this line in the sand, if you come back to this line, we're waiting for you. If price reaches that line in the sand, remember the recipe for termination conditions. If price reaches the line in the sand, they may unload. And that's exactly what it is. It's a very specific spot where the sellers have already taken over and where they may take over again. So it's absolutely, so this isn't the test. And let's go through the definition real quick. This divergence is not a test. This divergence creates this line. And I don't even know about it, Kenny. I don't know about whether or not this divergence is true until about all the way down here on the third bar. Let's see if we can find a moving example of it. So right now I have the potential for divergence. Do you see how there is no line? If this market keeps up right around the third bar, we'll know whether or not it's true. So there's not even a line there to reach yet, and it may never come true. And maybe the smaller chart will give us... See how that divergence didn't print until the third line. So it creates the line. No worries. And now there's divergence potential. And let's see if I get a third bar. Let's see if it's true, if it goes down. It may not go down. But do you see how there's potential, but there's still no line, even though the bar has formed? So divergence isn't reached. Divergence is a result of price and a loss of momentum. Come on, push down, NASDAQ. Let's see if we can create that divergence off the high. Boom, third line. Now there's a line that forms. Did you see that, how it happened live? We still don't have a line down here. That's pretty cool. That's a good lesson. So now if this were a large chart, what would we be waiting for? We would be waiting for divergence to reach this line, and then we would wait and look at our triggers and determine whether or not it's a termination condition. So price reaches the line. Now we're utilizing that line the way the trading gods intended. I love a live market example. And that's where people get a little caught up, is it's not the creation of the line that creates the termination condition, just like you said. It's when price reaches that actual line and the trigger lines stay above. Does that help, Kenny? So when we go back to your picture, when we rewind all the way back to where we began, we won't call it a strong top because it never was, it never had the chance to be a termination condition. That is an awesome lesson, and thank you, thank you, thank you. Well, Cindy, my brother owns the company. I get all the bells and whistles. Send me a check. No. How does it not look like yours? The fibs are different. The bars are different. The triggers are different. We have to ask ourselves, are we running the same workspace? Do we have the same one? My NASDAQ chart is not a 13.2 chart, guys. That's why I don't typically bring the NASDAQ up. My NASDAQ chart is a 10.2 chart. So we look the same on the large chart, but our small charts are different. You're showing me a 13.2. And I use, and this is why I'm on Simulator right now, I'm using one that's just a little bit faster. And if you can imagine, I sped NASDAQ up a little more. Because I'm working on something that my brother is working on, Cav, and I don't know all the whys just yet. So I'm trading his plan based on this chart to see if it works for me. Good luck with that. 5-1 is fast. Do whatever works, right? Yeah, I know you are. But do whatever works. Whatever works for you. One of the cool things is Cindy, you can do everything that you need to do with a 13.2. But with a 10.1, it's a half a step faster. I'm still forming an opinion. Because John Novak said. That's the only answer I have, Cav. And Jerry, I'm still forming opinion, and that is why you guys see Simulator. Because I'm forming opinions about it right now. I don't have any idea how I feel about it. So I'm practicing it, right? Because I don't have reps with it. Yeah, but John's 25 years ahead of me. There you go. There's your answer, guys. I don't know. I would say yes. Cav, I would say that if this picture right here, where did it go, is any indication, 12,000. And I know he did about 22,000 yesterday with it. Why try it, Cindy? Why not just be great at what's working for you, right? That's why I can't speak for John. You still have to be patient. I think you have to be more patient. But if you don't have rules for using a 10-2, just changing that number isn't going to make you into John Novak. Right? Play with it. I don't know what that means. What's a reversal line? That's just where his large chart reversal bar marker continues to move up with the trend. That's all it is. That's all that is. You can literally watch your there's my 13-2 reversal bar marker. There's my 13-2 reversal bar marker. That's all it is. Amen. And guys, this is why I don't open up my NASDAQ in class. Because it looks different. I don't have one, Jerry. I'm not in tech. I don't know. I stole John Novak's workspace. I just stole it. Took it right from him. I said, John Novak, give me your money or your workspace. And he said, dang it, Mark. Take my workspace. I'm all out of money. I spent it on a new platform for you guys. Hold on, Jerry. I'll give it to you guys. Shoot your feet off. I don't mind. There it is. Thank you. I don't care, guys. Take it. Take it, take it, take it. But I'm going to tell you right now. Let's see if there's a good picture. This is you guys, right? This is you guys right now. You're Pee Wee football. You think you're cool, but you look like a bobblehead. These guys know what they're doing. This is you trying to be these guys before you have the experience. And that's cool, guys. Do your thing. Do your thing. But one of the biggest mistakes that I see new users make is trying to get outside of their lane and trade like somebody with more experience. Well, John Novak uses this. I should use this. Mark Novak uses this. I should use this. When the reality is, guys, I'm on simulator right now because I'm still learning how to do what John does with this chart. And I'm 3.5 years ahead of you. So write your plan, stick with your plan. When you're great at your plan, add something, change something, look at it. Make small changes though. Or do whatever you want to do. It's not my job to tell you what to do. But I can tell you that termination conditions, they should, John. They probably do with Novak genetics, but the average mortal can't do it. Termination condition still stops the market, right, Cindy? Weak triggers lets me know it's more likely to hold. Does it matter what chart's over here if you're not going short? No, not at all. Triggers are still down, right? So I think it's important, guys, that you have a plan, that you look at your plan, that you understand your plan. Year 2 and 4 to get fancy. I like that. And until you're really comfortable with what you're doing, just relax a little bit. They don't hunt you anymore. That's still my weakness. I hate to admit it. Termination conditions are still my weakness. I'm such an egomaniac that I firmly believe that they will all break for me. Keep it simple, guys. I think my brother just likes throwing me out of my groove, and that's okay. How do you get to where you want to be? Post in the room. I don't care what chart it is. Post in the room. We'll talk about it. Yeah, genetics, you fought that one off. The others don't trade the wrong color. How easy is that? Let everything match. Guys, the more you post in the room, the more feedback you're going to get. You're going to get it from me. You're going to get it from my brother on days that he's bored. The more you take pictures and fill up your spreadsheet, the more you're going to recognize what it looks like to have your rules met. That's the key. Sorry, Paul. Not a high probability trend trade. Bad top, termination, gap theory, directly into a termination condition. Trig still up, could continue up or roll down. It's just do nothing, right, Paul? Just nothing to do. You don't have momentum. You don't have a clear path. It just means do nothing. It means I don't know what it's going to do, and my best bet is to do nothing. Termination condition, potential short or breakout long, who knows? I don't know. And I think that's what I try to instill in you guys, is that you've got to be okay with the idea that you can't predict what the market's going to do. The only thing that I can get from this picture is that I don't have odds favorable momentum and I don't have a clear path. Right? So Paul, if you don't have odds favorable momentum, if you don't have a clear path, take care, Jerry. Yeah. Are you willing to risk it, or just sit down? Wait a second, see what happens. Relax. Let life be easy. Nice one, John. I like that. Guys, put this on a t-shirt. Have your grandma stitch this into a pillow. Termination either gives you one or two outcomes, a breakout or a reversal in triggers. And only after one of those two do you trade again. Pretty cool. And then Paul, there's your divergence right from the one-to-ones, big window of opportunity. What did this end up doing, Paul? Did you end up getting a reversal bar for confirmation at any point, or did it just keep going up? Have fun at the gym, John. Don't hurt yourself. It just kept going. So we may have just discovered a bacon saver for you, huh? And then when a termination gives you those strong small triggers and the large triggers roll, maybe there's an opportunity. Nice job, Cav. We've seen this one about 4 times today, haven't we? Termination, starts to roll, pull back. Guys, we've seen this setup a lot today. You know that all this is a trade from 2004 that Nexgen used to teach. When Fibonacci holds and the triggers roll, look for a pullback. Nice one, Cav. And then look at that, Paul. You never got a reversal bar. But then you get that 50-50 with no divergence from the failed. You've got a tiny little window of opportunity, and it's freaking effortless. Paul, you may have just cracked the code to gold. You may have just cracked the gold code. Interesting entry. I'm not sure why you chose that area in the middle of nowhere, but it got you up to the one-to-ones. Not sure why you fought the triggers, not from an area. I don't understand your entry, Cav. I'd love you to talk me through it. Understood. No, I understand the large chart look. How did you pick this area floating in the middle of nowhere for your entry? Did you let it start back up? And I'm genuinely curious because I see you nail these so often. I'd love to know what you're looking for. See it? See what? Because you didn't go with the mid-band and you didn't wait for the synthetics, right? You didn't even wait for the pivot stop out. You're below everything. I'm just curious how you make this repeatable. And let me show you my line of thinking. Because of the large chart, I'm thinking up, right? Everything about me is thinking up. Termination, strong triggers, everything says let's go long. One-to-ones say pause, my small triggers aren't through. Split triggers say, man, that mid-band might not be the best one. I should probably wait for a pivot stop out, right? So this is where I say to myself, I've got this huge gap where this might go from. And I'm not there yet. And maybe since I know that it might not make it, okay, cool. I like, and this is an old trick, is putting a stop entry above that bar, because what it does is it gets you in at the midpoint on the first up bar. And that way, if it does pull all the way down and retest support, right? If it does pull down and retest those large triggers, if it does create the pivot stop out, then I probably don't get an entry until lower. And you have a plan, and that's cool. And this is just me trying to decipher it. And it doesn't mean that it's wrong or right. It just means I'm curious. I'm curious how that became your entry, because who knows? Maybe one day I'll want to do what you do. Agree, John. And that's what this one was right here. So this was the perfect 2004. It's just a little different. I like it. Large chart leads the way. Okay, John. All right, guys, that's it for pictures. What do you want to talk about? Yeah, no kidding. Sorry, Cav, I wasn't knocking your trade. John Novak came to your rescue on that one, but I was just trying to get a little smarter based on what you had. I know that you see the patterns. I know that's your pattern. I enjoy your charts. I learned something from all you guys. There's something to learn from everybody. What's cool is even if people take trades that aren't your trades, there's still something to learn, right? Even if people take trades that don't fit your plan, there's always something to learn. Look at how that termination condition stopped market cold. Look at how the gap theory went full rock star on it, right? Bing, bang, boom. Show me a picture, Sergio. And then Paul, with all the momentum, you take the snapback and just ride that wave of momentum. Nice trade. Nice trade. Where is 78? 78's all over the place. Is there a more specific question? First time the rules are met. I was trying to avoid that one. Here's the beginning of the day. Are you asking about the shorts? Well, see, how could I even know that? After 9 p.m. the long. After 9 a.m. the long. So let's go to 9 a.m. There was a long that failed with 3 divergences, and then it pushes back to support, termination, triggers roll. There's your pullback to the small triggers. If you were going to take a shot off the termination condition, a la (2004), and John, your pictures don't line up there. So what did it look like on a smaller, faster chart? It looked like a pullback to the small triggers wide and open, Sergio. So that's the exact same picture. Termination, small triggers roll, small triggers up. Small triggers roll up strong, pull back to the small triggers. It lines up right there with your large triggers. That was your shot. Does that make sense? First you have the termination, then you have the small triggers roll, then you get a pullback to those small triggers, and it typically lines up with your large triggers in an area. Ta-da! Teaching that one for 23 years? 21 years? Cool, so there it is. And what's cool is you can go through. So Sergio, anytime you see, you're like, man, how do I get in? Come back and analyze it, right? There's a termination condition. There's the triggers rolling. The large triggers never blinked. Multiple divergences, and then everything starts to agree. Notice that everything is green at the time of the entry. Everything but the background. So good question. Thanks. We were able to dissect that one and go back a little bit. And then John says, hey, here's everything that my brother said. That was the first one that failed with 3 divergences. We talked about that. That was the termination, pull back to the small triggers. And by this time, Sergio was still making money. He didn't bother to exit. He didn't need that next entry on the 50-50. He was still making money all the way up because that's how he rolls. But let's go see what it looks like on a smaller, faster chart. One divergence, all the momentum from a good bottom, right to support inside of favorable large triggers. And then just so that we can line everything up, I'll use circles instead of arrows and show the whole thing. There's your first entry that you had to manage out of with 3 divergences that pushed you back to the termination condition, that gave you the roll, that got you in. You see something cool? It's the same price. You see this a lot, guys. The same price. Just had to work through a little bit of the failure, and then off it went. What do you guys want to talk about? The classroom is yours. The platform is yours. Like 17 or 18 years old, 20, 30 years old probably. I don't know. I don't know how old he is, but God, he looks old. As of Sunday, he's only 2 years older than me, but he'll be 3 years again in August. I always joke with his wife, Melinda, that we are the same age for about 3 months, and then she's older than me again. Thank you. Yep, so we're about 2.5 years apart, Cindy. Close enough that I took a few beatings as a kid. Oh, that's your son's too? Nathan's? And far enough apart that once we got a little bit older, we can still relate to each other. So it's good stuff. My kids are 6 years apart. That's a pretty good gap. His kids are Irish twins, 11 months. 21 now. Buy him a beer. Tell him it's from me. Kids don't drink anymore like they used to when we were kids. Now they all smoke weed. Weed is the new beer. It's true. I am firmly on the belt buckle of the Bible belt here, and they still won't legalize it in Texas. A lot of good lessons today. A lot of good lessons today, guys. We've talked about pivot stop outs, and we've talked about termination conditions, and we've had opportunities to find entries earlier than the high probability trend trade. We've learned about confirmation. Talked about the gap theory. Guys, this is what we do every day. Every day we say the same darn thing over and over. Every day we talk about the exact same concepts. And the more you guys talk about them, the easier they are to recognize, the more lessons you get out of them. So Cindy, if your new homework is gap theory, all you have to do is go back and take the picture, right? That's the picture that you take. And I think that the most important part is that if price accelerates away from the large triggers and hits something, just say something, a line, it may close the gap. And fill up your spreadsheet. I'll give you the first one. John asks, is this a good trade if momentum trade is in my plan? Well, do you have momentum? You do. Are you coming from a termination? You are. Did the small triggers get through the area and then buy a snapback with momentum? It did. John Novak, I would say that this is a solid trade. This is that breakout, guys. When there's termination conditions, there's two options. Let me read this verbatim because I think my brother and I both agree that this is a good one. It's either going to give you one or two outcomes. A breakout, which is what he just bought, or a reversal, which is what happened down here. And then you learn how to capitalize on whichever one happens. If it reverses off of the termination, gets to another one, you're going to trade the breakout with all the momentum. If it reverses and there's a clear path, you're going to take that trend trade short. So, John, I approve your trade. And letting the small triggers get through the area you're trading from first is helpful. And then, Paul, your momentum trade is on its way up. And you're counting on that momentum taking you to the next level. As long as the smalls are still outside, you're going to give it a little bit of room. You'll force it to take you out, Paul. I love it. And what do we see? We see weak triggers, and now we have divergence. Maybe a deeper push, right? Oh, man, that happened almost instantly. Live, large and in charge. What's your thing, guys? Ask yourself that and then turn it into a lesson. My thing is trading in termination conditions. How do I avoid it? By identifying termination conditions before I ever think about pulling the trigger. My thing is trading without momentum. How do I avoid it? Well, I define. Momentum is slowing, right? But it's not gone. The path is still clear. We have the divergence, guys. Are we going to wait for an up bar to get us in? And if we never get it, we never trade? See how quick that happens? Have a good one, Cav. Thanks for being here, man. The large chart still says up. The large chart still says we have room to our target. The large chart still says. But the small chart and the little loss of momentum says it might push lower. Is it going to be this mid band? Maybe. Is it going to be this fib down here? It could be. But if I don't enter until I get a reversal bar, well, then I'm pretty good, right? It cuts my profits down, but at least it keeps me from just hoping that a mid band on the wrong side of triggers holds. Little way to use it. Kenny, I've had 1,000 reboots today and cleaned everything out. And there's different things to look at if we don't line up. What time zone are you in? Do we have the same midnight? Is it picking all of the same pivots? See, so you're Pacific. You are 3 hours behind me, Kenny, which means that your midnight is 3 hours behind mine, which means that we're working off a completely different number of pivots. One of the ways to combat that is to change your computer to Eastern if you're able. And mine's on Eastern, so my computer says it's almost noon, but it's only 11 where I'm at. I'm in a central time zone. But I have the same midnight as Nexgen, so my fibs are going to look the same as my brother's. Days back, some people maybe 20 days back. I'm always 10 days back. And John says 3 to 4 ticks is a pretty good for me. It just lines you up. Getting excited about odds favorable momentum and missing. It's a full price bar away. The trigger lines, the gap theory muser. That's great. That's great that you know that, right? So now what are you going to do? Anytime you look for a trade, I guarantee you're going to eyeball those large triggers because you know that's your thing. And that's all trading is, guys. It's figuring out what works for you. It's figuring out what doesn't work for you. It's figuring out what's making you money. It's figuring out what's taking your money and then turning it into a plan. So some of you are saying, I need it to hit that fib. And the only way I'll enter is if the small trigger, if I get a reversal bar, because then my risk is established. And I still know it's not high probability because I don't have an entry area and I don't have odds favorable momentum. So there it is. So I'm in. There's my target, right? If I'm in at 04, 14 is $100. That's my fib. My risk is established. And now I have to define. Well, what's it going to take to get me out of this medium probability trade? If divergence prints, you better believe I'm out of that trade, right? I'm not giving up twice the momentum. Guys, this is not high probability. This is just one way that you can allow confirmation. It is exciting. So Kenny, here, let me show you. And I'm just going to draw real quick. Let me open this up. All right, so yesterday, so this line represents midnight. Are you cool with that? So it's between this line and this line, and there's a day's worth of swings. If you are Pacific, you eliminate all of those swings. And you eliminate, well, and you actually add in extra swings going the other direction. So when your software goes through and it's running calculations 10 days back, Your midnights are different, which means that the pivots are different, which means they come from different ranges, which means they're going to show out in different places. It's the same data in, same results out. So my midnight and your midnight are different. And all of the swings that happen within are going to create different calculations, right? And then the new midnight and your midnight are different, which means that there's even more swings that are different that are changing. So you run into this thing. It's the same way if this represents, if this represents 10 days back, but you're running 12 days back on your software, then all of these swings are being factored into your fib creation. Does that make sense, Kenny? Because what happens between my midnight and your midnight may be enough movement to create different calculations that create different Fibonacci areas. You'll see it when Jen's back in the room. She is in British time. She's in the UK, and her fibs and mine never match. And neither of them are wrong. They're just based on different stuff. But if you want to be consistent with the room, the best way to do it is to have that midnight. And then John's saying the same thing. If you trade directly into the down triggers, you can usually wait and get a better fill. So you could say, okay, I got my reversal bar, but the triggers are coming down strong. Maybe I'll take it here, and my risk is established, and I've cut it dramatically. There's a million ways to do it. There's your momentum entry, and there's your exit with divergence, saying this party might be over. Pretty cool. And guys, I think that's a wrap for today. Good class. Great questions. A lot of good lessons going on today. We're going to come back tomorrow morning and we're going to do it again. We're going to do it every day. We're going to try and keep it simple. We're going to try and keep it focused. We're going to do our best to keep it basic and simple. And guys, I'm going to do this too. I'm going